Arrow is gone. It's another normal day at surveillance. Dan Ives soon.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities say the suspect in the shooting deaths of 10 people in an Asian community near Los Angeles has killed himself. The attack took place in a ballroom during Lunar New Year celebrations. It's believed the suspect, described as an Asian male, tried to carry out a second attack nearby. In the UK, ambulance workers are walking out today in the biggest strike by first responders. Trade unions are protesting pay levels in Britain's National Health Service. They're demanding a double-digit pay hike. Germany and France warn that the European businesses will have to ramp up spending to compete with the U.S. and China. German Chancellor Olaf Scholz and French President Emmanuel Macron met in Paris on Sunday. They discussed how the EU should respond to President Biden's Inflation Reduction Act. The measure includes roughly $500 billion in spending and tax breaks to benefit U.S. companies. Bloomberg's learned that President Biden will name Jeff Zients as his next chief of staff today. Zients is a former business executive who was one of the chief architects of Biden's initial COVID team. He'll replace Ron Klain, who will leave in the coming weeks. The White House chief of staff is among the most powerful figures in Washington. And hedge fund Elliott Investment Management has taken a multi-billion-dollar activist stake in Salesforce. Now, the firm says it looks forward to working constructively with the business software company. Shares of Salesforce have plunged since their peak in 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg.
Tech is really weak compared to everything else, or broadly defined tech, and that's just not something we're used to. The tech is this earnings season, if you take tech out, or tech broadly defined, you have a 5% EPS growth this quarter. I mean, who would think that tech is the thing that's holding everything back? And I think that this continues for longer than we think.
John Golub, just brilliant yesterday. Thank you for the notes on last week's effort. Lisa Bramowitz in Davos, and John and I are holding court on a really interesting week, and we're going to try to do that this week going into the Fed meeting that we have February 1. Futures -7, the VIX 20.28. Bonds not giving me much here, 3.50 on the 10-year yield. Lisa and I both noting oil, Brent crude, my eyes are failing me, 88.21. Every time I look, oil's up another couple pennies.
It's true.
or two. So there we are. Let's get to it right away. Lisa and I in New York, John Farrow in London, and joining us now, Daniel Ives. He's Senior Equity Research Analyst at Wedbush. We're going to dive right into this, and we're going to talk. There's so many, in a 2-hour conversation with you, we can go 8 ways. We don't have that. 2 things. Apple was a zeitgeist this weekend. They're separate and distinct, and the other's this news on Fortress Benioff. Let me start with Tim Cook. It's going to be a victory conference call for Apple. What will you listen for from the last non-layoff companies standing?
Well, I think, look, they were tacticians in terms of how they built the business, and demand, despite, many yelling fire in a crowded theater, is holding up a lot better than expected. We're not seeing any sort of major cuts. That's going to be a big narrative on that earnings call.
Explain to our audience the McDonald's-ness of Apple. They farm out their manufacturing like McDonald's farms out their hamburger. McDonald's serves hamburgers, Lisa. I don't know
Thank you.
if
I
knew
appreciate that.
Number 2, the franchise thing. Apple's almost doing a manufacturing franchise thing. So how unique is that within tech? To me, it's a huge distinction.
Well, it's one of their strengths. And it's why Cupertino is unique in terms of how they've built out in China and that supply chain. And I think the thing that, we've talked about more and more control of their ecosystem. Chips, they're essentially beating Intel at their own game. And the innovation that's happening in Apple, that gives them ultimately even margin advantage over others. And that's why in others in tech, they're laying off. And Apple, I think, opportunistically continues to add. So,
Salesforce right now, 79,000 people. Benioff is a force unto his own. Here's a fact. CRM down 51% from peak. Market drawdown 50%. Apple market drawdown 24%. What's the damage at Salesforce, and what does Elliott want to do to get it fixed?
I think for Benioff, clock struck midnight. It's not just with Elliott and other active Starboard and others. They're going to continue to drive, I think, significant margin improvement. Profits could be potential spin-offs and other strategic changes. And I think it just shows Salesforce, in a very strong position with their install base in cloud. Stock's been, an underperformer of late. And I think our view is that these are festival situations for activists. In terms of what I believe in tech, we're going to see more and more activists, especially in this market.
So Salesforce shares in pre-market trading up 4.4% after this announcement that Elliott had made this multi-billion-dollar investment in Salesforce. What other companies are good targets for this festival that you describe for activist investors?
Well, I think you're going to see it across the board in software and in chips. I think those are really the 2 areas that you're going to see activists really spend a lot of their time, not just because of the margin situation, but also this is the time where you're seeing tech firms cutting across the board, obviously despite what we're seeing with Apple. And I think that's really creating now in terms of M&A, growth opportunities, potentially drive more buybacks, dividends, especially in an underinvested tech landscape. I believe it's as underinvested as we've seen since 2009, which I believe the earnings setup is bullish over the next few weeks.
What are you pointing to when you say that? Because some people say that's actually not true and that people are still heavily invested in big tech. They haven't given up the bet. What are you looking at statistically to say that they're actually still underinvested?
Yeah, I can tell you, talking to institutional investors 22 years, this feels more like 2009, 2002, relative to sentiment. I think how many are invested going into earnings. And I believe right now, New York City cab drivers bearish on tech.
I looked in at the dividend growth of Apple to bring it back to the Cook Victory Lap and the Cook Victory Conference call. I don't understand. I get the whole share repurchase thing as well. It's almost like they don't want to be a Dow successful blue chip stock. Dividend growth over the last 10 years from 11 cents per share, and in many fewer shares, I believe they're up to 23 cents right now. Do they shock the landscape by popping an institutionally appropriate dividend?
Well, I think for Cook and Cupertino, that's always been the conundrum because it sends the signal in terms of growth. They don't want to be known as right lane going 45 miles an hour because this is actually a company going 70.
A 1% yield is right lane going 45 miles an hour?
Well, I think for them right now, they're going to try to find that sort of balance in terms of dividends and buyback because, this is a company that continues to generate just massive, massive cash flow. And I think it's that balance. But they are going to continue to innovate and grow in some of these huge growth areas.
So who are they going to cannibalize from? You mentioned Intel and how they're beating Intel at their own game. We get Intel earnings on Thursday. How much are we going to see Apple really hurt chip makers by making their own and circumventing them entirely?
The scariest thing to the chip sector is Cook and Cupertino, because they're essentially, you're talking about one of the bigger buyer chips, and now they're going to really own more and more of that landscape. They want more control of their ecosystem, and I think you're going to see that more and more, not just on the chip side, but even in AI and some other areas. And I think that's a theme that we're going to see with Apple, because if Tom talks about this period of time, they're going to get stronger, Apple.
You've been very vocal about the haves and the have-nots within big tech, and you're giving a pretty rosy picture. The underinvestment in the Apples of the world, perhaps in the Salesforces of the world, if activist investors get involved. What about Facebook? What about Meta? What about some of the others that have perhaps a bit more of a challenge in a different way?
And I think there you'll continue to see from Zuckerberg continue pivot further and further away from metaverse. I mean, obviously that's a long-term strategy. But
will it be renamed Facebook?
I mean, look, because realistically, they're going to realize more, and you see why that stock's up significantly since those cuts. They got to double down on social media. It's an arms race there in terms of digital advertising, what's happening. And that metaverse strategy, which seemed so good 12, 18 months ago, name change was awesome, PR move. I think more and more realizing that that was not the right move.
What's Valentine's Day look like for Mr. Musk? What's his February look like? I mean, there's so many moving parts here. You're expert on the Tesla thing. Twitter's a private company. But Dan Ives on how Elon Musk gets to, I don't know if is it a leap year this year? How does he get to February 28?
Well, I think first it's a CEO of Twitter. I think that's really important, further distancing himself.
Are you shortlisted?
Look, in my opinion, I believe, you know, even though
no, he's not.
Even though
just like Pharaoh,
even though that's something. No, but seriously, I think they have to. He has to name a CEO of Twitter. You got to rip the Band-Aid off this week in terms of deliveries, in terms of what I believe is probably 35, 40%. And then I think third is just really showing that demand story is going to be strong.
Just real quick here, when are layoffs not going to be a great thing for the shares of these tech companies? Because that's what we've seen pretty universally.
Yeah, I think we still see another 5 to 10%. If we get into the middle of the year and there's more and more cuts, that's where it gets darker. But right now, it's an excuse for these companies to cut after spending like 1980 as rock stars.
John from England emails in and says, Sterling's 124. Ask Dan what his price target is on Apple. Pharaoh's got to make some money here.
Yeah, so 175 base, 200 bull case, and I just believe this is one where many yelling fire in a crowded theater, but Apple's going to be a rock of Gibraltar in this earnings season.
So you got a bull case there, 137 to 200?
Yeah, and I believe right now, you start to do some of the parts. I believe the services.
What's some of the parts? Come on.
Some of the parts services business, you could rationalize the services business conservatively 1.4, 1.5 trillion. And you start to sort of, you look at that hardware business and where we're going to go into an iPhone 15 cycle, and there's a stock closer to $200.
Come on, what's the share price on that? I can't read 8 pages of Ives. What's the sum of the parts share price?
So share price right now, you have what I view is $70 to $80 right now per share is the services business.
And so you're getting everything else for on your 200 for like 100.
I believe you look at iPhone hardware business significantly being underestimated in this multiple compression market.
You don't see this on radio. Lisa, my clothing consultant, just emailed in and said, "Can you get the Ives look down?"
You know, honestly, I just well, yeah, we're going to work on that later. But I do want to just say, you're the one who compared Apple to McDonald's. If you go to an Apple store, there are people lined up, can't get people to check out quickly enough to buy $1,000, $2,000 of merchandise.
No,
so this really speaks to what Dan is talking about.
Their process risk and distribution risk off their income statement is brilliant. I mean, this goes back to Larry Haverty and the rest of them. Dan Ives, thanks so much. Don't be a stranger.
Thank you.
Very visible. I hope those are good questions to inform you on technology or into a Monday as well. Futures -7. We're looking at the bond market. So is John Farrow in London. An important conversation coming up on fixed income in London. Alifa Dorwala with us as well. Rock Creek. Stay with us. This is Bloomberg. Good morning.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
Who's not backing down.
What is the market saying? I don't believe you. It's it's pricing in rate cuts. It's already seeing the data roll over.
The way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough.
At some point you have to move to 25 because you've done a lot. You don't know how much damage that you've done.
Expectations for the remainder of the year for 2023 are quite bleak. Earnings are supposed to go down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow in London, Lisa Abramowitz back from Happy Valley. I'm Tom Keene with Lisa in New York. We welcome all of you on radio, on television, an eventful 5-day work week. Everybody on board this week into the Fed week next week. And Lisa, it's real simple here as we churn here with economic data, GDP coming out later. First look at Q4. It's all about driving to February 1.
How much do we get from the Fed, this feeling of that step down that they're talking about? Does it really matter? But this is really the issue to me is, does it matter? Does it basically just mean that they're building an insurance by going slower, but they're going to get to the same place and hold it there for just as long? And that, to me, is the distinction that is really being debated in markets.
You know, you were in the Gulfstream in the Zurich runway there on Friday. We were talking to Andrew Hollenhorst. Hollenhorst was on fire with Citigroup. With there, he said, yeah, we've gone 50 to 25, but he did not give up on the migration to some form of 5-ish terminal rate.
And he's not alone. A lot of people saying the same thing from the analytical community, but the market's basically rejecting that and still pricing in rate cuts. At this point, how much are we ignoring the inflationary impact of China reopening? How much are we ignoring the inflationary impact of a Europe reignited by a warmer winter and people able to go out and spend, and different aspects of the inflationary picture continuing to accelerate? These are some of the issues people are worried about, and the head of the Norwegian Sovereign Wealth Fund basically said we could see inflation reaccelerate, and that would be a worst case scenario for all assets.
Okay, that's the gloom, but that's around hydrocarbons and thank you, Will Kennedy from London, for I think that's Farrow's over. They were partying last night. I think Will Kennedy and Farrow.
Is it a new LME week?
Yeah, it's an element. When John's in London, it's always LME week.
Yeah,
we know that. 88.40. Just as the beginning of this show, we're about ready to round up Brent crude to $89 a barrel, and that folds into that inflation lift the gloom crew's talking about.
Everyone said that there would be more demand coming from China as they come back online. The Lunar New Year is being celebrated this week, so it's quiet over there. But after you start to reopen, after that, you might get a real sense of that. At what point then has this been a story about energy and energy prices that went down, and all of a sudden disinflation was the story?
Right.
And now if prices go back up, people have to start thinking about what happens if that really is the
We
issue.
have to see, and of course, the school of thought on China opening and demand large, that we will get some form of lift here above $100 a barrel. We're halfway there, I'd say, off of the disinflationary joy that we saw a number of weeks ago. We got a really nice synthesis coming here up here on EM and global economy, but I think we really got to go through the data now. Futures give me nothing this morning, -3, right on the screen throughout. VIX giving me nothing, 20.22. Yields lower. We are on the low yield watch. That turned around abruptly. I think it was Thursday. 3.50 on the 10-year yield. A little bit of less inversion, but I do want to point out 10-year real yield, inflation-adjusted yield, my benchmark still quiescent at 1.25. And Lisa, just to close it out, the Bloomberg Financial Conditions Index is back up to an accommodative positive 0.20. The number doesn't mean anything, except that Jerome Powell says it's a job not done. Major thing.
The issue that I have is people have stopped talking about this, the financial conditions aspect. They're saying, they're just looking at the real data and they're going to be patient. This is a tension. How much do they talk next week about the financial conditions and the easing there and what that means for their inability to transmit financial policy through that? Here's what we're looking at this week, because today is a pretty quiet week in this quiet period ahead of the Fed meeting next week. Treasury auctions. We've got the 2-year note tomorrow. We've got the 5-year notes on Wednesday, and we've got the 7-year notes on Thursday. Watching the 5-year, the belly of the curve, where a lot of people were investing, how much do you start to see people move back from this belief that the Fed will go enough to stymie inflation in the longer term? How much do you start to see people bake in the expectation that inflation will remain higher for longer? This week, a slew of earnings. We got Microsoft on Tuesday, Tesla on Wednesday, and Intel on Thursday. I'm especially interested to hear what's going on with the chip makers, especially in light of what Dan Ives was just talking about Apple kind of cannibalizing the business away from the Intels of the world at a time when they've got a glut of chips. Very curious also from Microsoft about Azure, the cloud computing system and the investment there, how much companies are going back to those tech investments. And Friday, we get a slew of data after getting the GDP print for 4Q, after we get a host of other data, durable goods. We get personal income and spending and core PCE, the key metric that the Fed looks at. It has been rolling over just a touch. Does it turn the other way? And does it flatline? How much does this give a sense of where we are in the base looks that people look at to get a sense of inflation?
Yeah. Headline right now out on the Bloomberg. I want to underplay this. This is Spotify of music streaming. They've got some real competition from Apple Music and the wonderful title, Spotify to cut about 6% of a 7,000 workforce. Not a big deal, but at the margin, they're sort of a tea leaf for the morning.
Well, just the layoffs continue and the shares rally. I mean, to me, that's you
mentioned that, Mr.
The
Ives.
shares are up more than 3% now ahead of the market. That's what you see. These tech companies announce layoffs, their shares rip.
Friday, as we were resetting for the weekend, we really decided to look at asset allocation. And we continue that theme this morning with some good other stuff coming up. John Farrow in London on fixed income strategy here in a bit. But right now, Alifia Dorwala joins us with Rock Creek Group. They are an exceptionally thoughtful group with real hydrocarbon focus and also with an EM bent. We're thrilled she could join us this morning. Alifia, what is cash right now? Is cash an asset?
Last year, cash was definitely an asset. We were overweight cash and it helped our portfolios. This year, we are starting to put a little bit of money to work incrementally within fixed income more than anything else. A little bit too early to be really chasing fixed income, but we think that at some point we're going to want to start extending duration. So fixed income is a big focus today.
What do you do with energy as the only survivor of an ugly 2022? You people have got terrific natural gas history. How do you frame that, or how do you bet on that out 3 years?
Yeah, and Lisa, you mentioned two of our main themes. Will the energy shock from the war in Europe continue to be contained, or do we see part two this year? We saw winter warmth, we've seen European subsidies, we've seen the U.S. tapping into the Strategic Petroleum Reserve support, containment, and then we see China, on the other hand, demand for oil is going to increase as China reopens. And so we're kind of looking at all of these factors and saying, is the second half of the year going to be a little bit like we were seeing some of the tensions in the last year?
So let's put those two ideas together. You were saying it's not time to lean into duration, but you're waiting to, and the potential for the energy crisis to rear its head. What are you waiting for? We've seen a rally already. So yields are already almost a percentage point off the recent highs for the 10-year. What are you waiting for to say it is time?
Yeah, and it's a continuous conversation as markets are moving, but we've seen a disconnect, right, between market expectations and the Fed's hawkish announcements. The 10-year seems to be stuck a little bit around 3.5% because markets think that the Fed's going to have to pivot and reduce rates. We think that the 10-year could retrace to around 4% at some point early this year, and then that's going to signal a good opportunity to slowly start buying duration. Again, we're looking for good entry points to start extending duration in our fixed income portfolios, but we don't want to chase anything because we do think that we're still a long way off from the Fed really signaling any sort of even pause.
What's interesting to me is the idea of a 4% 10-year yield and the implication for equities that previously sold off when yields went up. But if we have an environment where it's a positive look at the economy, at what could potentially happen with growth, is it also going to be positive for equities in the short run?
I think equities are going to be maybe potentially a tale of two halves this year. We think kind of middling for the next 6 months, but I think you're going to have to pick your spots. You have to remember the S&P is still trading around 18 times, whereas Europe's trading around 12.5, and EM in certain countries even lower. So it could be a valuation story the first half of the year.
Alifia, with you and Afsani, let's just talk about the Vogue again. I believe it was a Vogue 12 months ago, 24 months ago, 36 months ago. You get the theme. EM and international are back. Is this time different?
It feels like a little bit of a consensus trade because you're starting to hear people really talk about it more. And again, you can't generalize EM. I mean, China to Brazil to India, these are completely different factors, completely different time horizons you have to have. But as an institutional investor, you have to be in emerging markets. And to some extent, you have to get China right, because that is still the biggest determinant in an EM portfolio.
Alifia, thank you so much. Alifia Dorwala with Rock Creek Group there on the allocation mystery. Here, we really tried to cover that here in January as we move forward. As John says, market outlooks ought to be done March 31 after everybody gets the year set up. Doug Cass with a really important insight. Thanks for listening and watching down in Florida, Mr. Cass. He's with Seabreeze with real money at risk. And when we talk about share buybacks, and Doug Cass, Dan Ives is really good at this. Lisa, there's two kind of buybacks. You buy back shares and your share count goes down. Think Intel 15 years ago, think Apple now. And then there's you're buying back shares and you look brilliant, but it's a complete shell game because you're issuing shares out for compensation. And it's a wash. Mr. Cass mentions this with Amazon and the like. I think that's a really important technical point that's often missed.
Well, there's a bigger point behind that, which is people look off into the share buybacks as a tailwind to a lot of companies and a lot of their performance, and there isn't as much share buybacks that are planned this year. So what kind of pressure is that for equity performance at a time when shares are lower, and that won't necessarily be the counterbalance? And that's something people are analyzing.
There was a great study done a million years ago. I'm going to pick on Textron, which is a name from the past. I'm not sure that was the company, but we'll say so because it's a Monday. And basically, they did a study at Textron, and basically companies buy back their shares at the top of the market.
Yeah, well, that's exactly what happened.
And they say, no, we don't want to do that at the bottom of the market. That's they're no brighter than I am. They should be in the triple leverage share buyback program.
They're in the triple leveraged Austrian bond program, I hear. It's a really successful.
You were not there for that. That was painful. I mean, some of these bonds, I mentioned, I don't like to mention bond names on air, but in the old days where Pim Fox and I would get out the Blue Book and look at the Standard & Poor's Blue Book, I mean, a given investment grade bond is down 10, 15, even 20%.
It's going to take a while to get that back, right? And so have we reset to a normal that's going to be sustainable, that can actually compensate for all those losses?
Working right now on getting up the Fulham countdown clock here to the Fulham Tots game. Farrell will be in attendance.
You're back to that?
He's in London. I'm sorry, brain freeze. Excuse me there. Ian Steely will join Mr. Farrell. He is with JP Morgan in London. Look for that here in a bit. Futures at -4, Dow futures at -4. How can that be? SPX Dow, same futures. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Poland will ask Germany permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister said if Berlin were asked about the tanks, it wouldn't stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. In California, authorities are trying to figure out the motive for a mass shooting in an Asian community near Los Angeles. 10 people were killed when a gunman opened fire in a ballroom during Lunar New Year celebrations. The suspect, described as an Asian male, was found dead of a self-inflicted gunshot wound. The Justice Department has found more documents containing classified information at President Biden's home in Delaware. FBI agents searched the home for more than 12 hours. They are said to have found classified notes from the president's time in the Senate and vice presidency. In the UK, the power grid is asking some households to cut energy use today, and it's likely to extend the request to Tuesday. A plunge in wind power and freezing temperatures are testing power producers' ability to keep the lights on. And Spotify is the latest tech company to cut jobs. The streaming giant said today it is cutting its employee base by about 6%. The company has about 9,800 employees. Spotify's stock fell 66% last year as investors questioned when they'd see returns from big investments in podcasting. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Earnings season is here.
Wall Street expecting a bit of an ugly season. People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
should have a clean lift of the debt ceiling because the 14th Amendment to the Constitution says nobody should question the creditworthiness of the United States. I don't think anyone should flirt with not paying the U.S.'s credit card, which is what Republicans are doing. We should raise the debt ceiling. But if Republicans are saying they won't do it and they're threatening our creditworthiness because they want cuts, let them put cuts on the table.
One of my favorite people on the planet, Timothy Kane, understands that if you are at the University of Richmond, you get to go to the ring dance, which is a holdover from another time and place. He is the former mayor of Richmond. He taught at University of Richmond Law School and worked his way along the path to a vice presidential candidate with Secretary of State Clinton, and then on to his work in the Senate himself. He's part of the matrix that's out there. John Farrow in moments from London on fixed income, Lisa Bramwitz and Tom Keene in New York on radio, on television. And we go to Anne-Marie Horton, Bloomberg Washington correspondent, to speak of Senator Kane and the idea that's percolating, Anne-Marie, of governors as presidents. Civics 101, do governors make good presidents?
I think some might agree. I guess it depends who you ask. They have their own little fiefdoms and domains, right? So they're almost the president of their own state, so they go through the motions. I think at this point in Congress, things are so volatile, which is why you see both parties potentially looking to governors to be their leaders in the 2024 election, especially on the Republican side.
Greg Valliere with Bloomberg earlier this morning in his very early morning really emphasizes this today, and it can be the governor of Michigan, Democrat, it can be the governor of Florida, Republican as well, but they're percolating up. Are they advantaged in terms of getting ready for the primaries because they're distant and removed from the Capitol Hill Derby?
I definitely think so, especially when you just see the fact that there's just nonstop political debates, even on things like, obviously, the debt ceiling, which has been the central debate on Capitol Hill between Republicans in the White House, Republicans and Democrats, what they're going to do about it. And does this really even resonate with the American people that are worried about everyday things like higher grocery costs or higher rent? And we spoke to Governor Sununu of New Hampshire last week, and he was pretty direct when he said, God, no, I'm so happy I'm not in Congress. And he thinks he can get a lot more done outside of Congress, and it does set individuals like him up for a better run in terms of especially the PR when you want to pitch yourself to the American people.
And Lisa, percolating over the weekend, boiler up, that would be Mr. Daniels of Indiana percolating as well. Mr. Trump, I guess, pushing against that a little bit as well.
The subtext of a lot of what you're asking Anne-Marie about is, will President Joe Biden run again? How much pressure is there?
I forgot to mention that small matter.
I mean, that's basically what we're talking about here.
Farrell went to London and you're replacing him,
but what's the pressure here? And how much is it really ramping up from other Democrats against President Biden, saying, stop it already? You're not popular, especially with the classified documents, which we didn't mention last hour, but we'll mention this hour. Let's start setting people up to run instead of you.
Listen, the classified documents and the drip of them, and over the weekend we have another one, an FBI search, more than 12 hours, a fourth batch discovered. All of this is going to make it a lot more politically embarrassing and harder for the current president as he wants to potentially talk about a 2024 campaign and run. On the other hand, this president did get a lot done in his first 2 years as president, right? And at the same time, there was supposed to be this massive red wave referendum on President Biden in November, and there was not. So he is in a position now where many in the party do feel like if he wants it, he has proved himself. But again, yes, there still, of course, are those whispers about it is time for a younger generation to take the lead.
Biden should be embarrassed by the situation. The words yesterday of Senate Majority Whip Dick Durbin talking about what's going on with the classified documents. There does seem to be a lot more pressure. I understand some of the wins. I understand some of the arguments on the other side. If former President Trump doesn't run, is it likely that President Biden will also step down from the race?
Well, it's an interesting question because if you look at one of the latest polls from Suffolk County, USA Today, it shows that Biden would still beat Trump, but that, say, a Governor DeSantis entered the race, he would be the one that could beat Biden. So potentially, if Trump was to bow out, the current president maybe would also look to the Democratic bench, which at this moment looks kind of slim. But the president also has to be careful about the timing of all of this. He will become a lame duck president the moment he says he does not want to continue to a 2024 race.
I look, Anne-Marie, at the setup for the week and the politics that's folding out. Help us with the calendar into the year. When does the primary season start? And by that, I mean, when do the centrists from both parties confront the very hard left and very hard right wings of their party? Is that autumn? Is that summer? When is it?
Well, I think it's already started. We heard from Nikki Haley on Fox News talking about the fact that she hinted about her own run and wanting to get involved in the Republican primary. There's really no reason why anyone should come out too soon. Right now, we only have one individual that says he is running for 2024, and that's former President Donald Trump. So a lot of people want to see who decides to get in the race and if they are going to want to go up against them. One of the more key parts is who, once you're in it, when do you back out? The timing of backing out and making sure that you are part of potentially a future candidate and giving that individual the help and the leadway and the campaign financing that they would need. But I would say by the summer, you'll have a lot more names percolating around Washington.
Anne-Marie, just real quick here, which party gets hurt the most by the debt debate, the debt ceiling limit, and all of the drama around that?
After the debt ceiling.
Well, yeah, it's interesting.
if you look at past polls, it is Republicans who have fared the worst when it comes to the debt ceiling, and this goes back decades because they continuously bring up this fight, saying that they want to negotiate spending on it. When you saw during the Trump administration, Democrats went on with the debt ceiling. The Republicans had to raise it. The former President Trump was in power, and they voted for it. So when you look at past polling of the American people, it's the Republicans that it actually hurts more.
Anne-Marie Horton, thank you so much in Washington this morning. We'll continue on that. Right now, Ian Lingen publishing moments ago, and he says this is not 2011. Treasury dynamics will be very different off the shock of any kind of rate decrease, a rating decrease, I should say.
And there also is the lessons learned from previous eras. And, you know, we were just hearing about.
I do agree with that.
And just what Anne-Marie was talking about, the sort of political liability of being on the wrong side of this debate. Even former President Trump was out saying, please don't do this. Don't be an obstacle to passing this. He was talking to fellow Republicans. This is really an interesting moment as we end up with something that could be dramatic, but people aren't necessarily pricing in yet.
Well, we'll have to see. I mean, it's to me, I'm still waiting to get out to summer. And as we heard from one Democrat, I'll be honest, I can't remember who it was. Maybe it was Senator Kaine. Can they just show us their spending cuts? Which is what they don't want to show. I mean, they don't want to play that card, to say the least.
Yeah, well, it's not very popular for Social Security payments to be cut off, and that seems to be a big concern.
Would that happen if there's some form of shutdown? Is that like?
I will just throw out that it has to become an issue. If banks don't understand where the funding is going to come from, will they actually process payments? There are things like that that go on behind the scenes.
This is like hot stove league. It's a hot stove league debt ceiling topic, like the Red Sox. It's just painful.
It is painful. I will say that.
Painful. Painful. Also, the Bitcoin. I sold it all at 15,000. 23,000 on BitDog.
When did you get so interested in Bitcoin?
Matt Miller grew a beard. I said, that's it. I'm gonna,
You're going to be all in on Bitcoin?
All in on Bitcoin.
I mean, where did this come from?
Futures at -3 if you're brave. The VIX 20.18. 10-year yield. John from London emails in and says, it's cold here. Quote bonds more. 2-year yield, 4.18%. Stay with us from New York, from London. This is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance, good morning on a Monday. Bramwell back. She says bonds, bonds, bonds. We'll be looking at bonds, bonds, bonds here through the hour. Let's do a Pharaoh-like bonds, bonds, bonds data check. We'll do that 4.18% on the 2-year. Well, it was sort of down towards 3.99, didn't get there. Reversed back a little bit higher yield, up a basis point. This morning, 3.50% across the 2-year. And the former benchmark piece, somewhat related into a 30-year mortgage, 3.68%. We're watching Brent crude seriously, 88.27. It gets our attention. Pharaoh in London with an important bonds interview. We're going to do one here in a moment. Lisa, I want to go to you. How about that housing market?
Yeah, well, that's been a serious question. How much more pain is there? And honestly, when I was speaking with people last week, they were saying there could be another 10% decline.
Come on. This is what drives me nuts about Davos. The people you're talking to can't decide on a weekend whether to take the helicopter to their 4th or their 5th home. I should listen to them about housing?
I take your point. There is a feeling of how close are you to the reality of anything that normal people deal with at sort of a highfalutin kind of affair like this. That said, when people look at the granular data, there has to be some retracement with mortgage rates where they are. And that was definitely a theme that we heard pretty persistently, not only from executives, but also academics and others who study the market.
What did you learn, I'm going to guess, off-piste, as they say, when you're off the deck of the famed Davos view of Bloomberg? What did you learn about the Schwartzman-Blackstone real estate experiment, as they call it?
So basically, if you end up as an institutional investor owning large swaths of single-family homes and renting it out, what do you do? Honestly, I don't have intel in terms of whether they're going to keep buying or whether they're going to sell. But what you are seeing in the data is that rents are continuing to climb because people are priced out of buying those homes because of the mortgages.
Do you think that's a tangible factor?
I do. I think that, because honestly, if you look back historically, rents don't go down that easily. It usually they stay the same and people have to be housed.
We're as guilty of this as anyone. John Miller owns a high ground on this, and once again, a luxury apartment study this weekend of stuff nobody could even, I couldn't even afford the tax payment, let alone the property.
Yeah,
I just wish John Miller, with all of his wisdom, would actually go to like Queens, 47 blocks around 6 Greek restaurants. We'd probably learn more from that than anything else.
Well, there's a huge bifurcation, and we see this ongoing, and this is why it's so hard to get a handle of the data between the lower end, the middle end, and then the high end, which seems to be insulated from a lot of the pain, and we continue to see that, whether it's the housing market or beyond.
Do we have equity love
we
today?
Do.
What are we doing with the
Spotify? Let's start with Spotify because they announced. Well, we talked about how they cut, or they're announcing layoffs of about 6% of their jobs, and What I find interesting is the shares are popping. They're up almost 5% ahead of the market. To me, how long does this go on? Where if big tech companies or even medium-sized tech companies announce layoffs, their shares rally. And we just heard from Dan Ives, it's probably going to happen until the middle of the year, and then people might end up getting a little bit more concerned about more pain.
Can I just, with Spotify, and you know, what do I know about this? 4 years, 5-year track record, they're negative 40% per year total return. I mean, is this a viable business? Are they a zombie company happen to be trading public, I guess is what I'm asking.
And I'm not going to answer that, but I will frame this in another way, which is how do you identify the tech companies that have staying power, the Apples of the world? How much are we looking at a sea change in the business of, say, podcasting, which Spotify was massively invested in? So we do have that. Also, I wanted to take a look at Salesforce because the Mark Benioff empire, as you were talking about, you do see Elliott Management coming in, the reports that they had made a multi-billion-dollar investment. I find it fascinating, this point that Dan Ives also is making about how it's going to be a festival for activist investors, and those shares also are up about 5%. Basically, they're going to make the cuts necessary, make the management changes, do the spin-offs to get some action back to the shares and some value. Tesla reports earnings on Wednesday, and those shares are up about 2.2%. They announced cuts, and you talked about them on Friday, cuts to the pricing.
Yeah, very interesting, actually. There's been some very good reading on that.
But why? Is it because of a lack of demand, or is it because they're trying to basically price out their competitors and get ahead of the GMs and the Fords of the world?
They're exactly right. And what they're doing here, when revenues are price plus units, cut the price, units go up, and revenues do better than you would think with a 20% price cut.
So how much does that really give a feeling ahead of the following week when we get the GMs and the Fords of the world reporting earnings? Do we get a sense of what the demand is like from those earnings results?
We will see. And again, the 10-year yield 3.50%. In the crosshairs of the retail damage in fixed income, truly an historic year, is the Charles Schwab Company of San Francisco. From the Schwab Center for Financial Services, Colin Martin joins us right now, their fixed income research acts. Colin, I'm going to cut to the chase. It drives me nuts in financial media where fixed income sophisticates talk about spread, they talk about dynamics, they talk about as if 2022 didn't exist. I looked at one blended iconic bond portfolio down about 17%. I looked at an individual piece, which I'm just going to mention. The 30-year Microsoft piece is down 30% from its price peak at 110 as well. Let's begin with a look back. How bad is the carnage?
Well, Tom, it was a really bad year in 2022, and what we tell our clients at Schwab is, unfortunately, we can't undo that. How we do like to frame it, though, is making sure that you're really matching the investments you own with what your time horizon is. So I'm going to use that Microsoft example you just gave us, because a lot of times in the financial media, we hear people sort of sensationalize things with like the 30-year treasury and, you know, the carnage we witnessed there. But the way we look at it, Tom, a lot of our clients and a lot of individual investors aren't owning 30-year treasuries or 30-year Microsoft bonds. Maybe they have a liability in 30 years, but we don't think a lot of our clients, a lot of individual investors own them. So we really focus more on the intermediate side of the equation. But I think another way to frame it is what I said before, is matching that time horizon. If you buy a bond and you're holding it to maturity, these prices are unrealized. You know, these are not actual. They're paper losses, they're not realized losses, and you know what to expect at a given time frame. Now, the same is not true for funds, of course, and that's a whole different story. But we can't undo what we saw last year. It's been a strong start to 2023. We don't expect this pace to continue, of course, but we still think the outlook is favorable now. But again, you just need to align your investments with your time frame and objectives.
And what's so important there, folks, is Mr. Martin absolutely nails where people like me go out to the sensationalism of a 30-year, or dare say a 97-year Austrian piece to get a big number to make a banner pop on television or even a banner to pop on radio. With that said, what is the duration that you have? The duration of U.S. paper is 5, 6, 7 years. Do you come inside that within most portfolios?
No, we think that's okay, Tom. And actually, if you're looking for good examples, instead of a 30 or 50-year, you can go to those European 100-year bonds. That's going to give you, better bang for your buck. But in terms of what we're telling our clients, five duration or even a little bit more would be okay with us. The way we frame it is to not just be short right now. I know that's a concern, especially given last year's performance, but we think there's this idea and hesitancy to move further out in the curve because of the inverted yield curve, right? A common question is, why would I invest in a 10-year bond at 3.5% if I can get more in a money market fund or a 6-month T-bill? And we'd rather lock in those yields with certainty. So what that magic number is, we don't really have one. It's going to depend on each individual investor, but we think it's probably a little bit longer than what most individual investors have right now.
Colin, don't you get a little concerned or feel uneasy given the rally we've already seen, how much yields have come down? This concern that maybe the trade's already up?
It is a concern, Lisa. When we published our 2023 outlook, we thought the 10-year could fall to the 3 to 3.25% range, and we got awfully close to there in just a couple of days. Our guidance is a little bit more difficult now, and we understand it is a difficult pill to swallow to accept a yield at 3.5% when it was just 4.25% for the 10-year, back in October. So it is a little bit more challenging, but our outlook really does remain the same because we do think growth should continue to slow. We think what we've seen in the soft data should translate to a softening in the hard data. We think inflation is going to continue to trend lower. And we think as time progresses, we will see those Fed rate cuts. And that's really what it comes down to, because if you look at intermediate and long-term yields, markets are forward-looking and they're seeing, well, what's the average of that short-term rate over X period of time? Now, we don't know if those rate cuts are going to come in 2023. We think it could be a 2024 issue. But we do think that as growth continues to slow, we will see yields kind of across the curve, especially on the short end, fall a little bit. That's a second half 2023 and early 2024 issue, though.
Colin, when do you think that inflation will fall to 2%, the Fed's goal?
It could be later this year. It's probably a 2024 thing. One thing that we look at a lot is wages. Yes, they're coming down, but they're still at an elevated level. And I think that we know is a key driver of inflation. And when we just look at the broad labor market landscape, it's still relatively strong. We're still trying to figure out how we marry the two issues of the headlines we see of all these job cuts and hiring freeze announcements with a still low unemployment rate. But given that hard data we see, we think the labor market's remaining resilient. We're also looking at these monthly numbers. So I think the PCE report this week is going to be important. We're still at that, 2.5%, 3.5% level if you look at those monthly numbers. So we're still looking at 2s and 3s, 0.2%, 0.3%. We need to see 0.1 and 0.2s before we're more comfortable that we're going to get to that 2% level.
Colin, really thoughtful. Thank you so much. Mr. Martin is a Schwab Center for Financial Research as well. What he said there, Lisa, I really can't say enough about it, which is if you've got something moderate duration, you're in carnage, down 15%, down 10%, you're scared stiff, you just hold the puppy back to maturity. The iconic book on this is Inside the Yield Book, Sidney Homer and Marty Leibowitz. I was directly involved in bringing back the second edition of it. It is a rite of passage in bonds. You have to read it, and the major message, which you heard from Colin Martin, is don't panic and hold it to maturity.
Well, and just to extrapolate that out, this was one big discussion, and it has been in the private markets, where if you basically just don't price in the pain, does it go away? Because everything will get back to where it was and the value that it used to have. You've got regulators, you've got central bankers saying, no way, this is going to be an area of pain, and you have people in the market basically saying, this is why it's good not to have daily pricing.
I don't know if I'm more depressed. 50 years on from Inside the Yield Book, the majesty of Sidney Homer and Martin Leibowitz, or what Fulham's going to do. Fulham? Which is it?
It's the one that doesn't indicate what we're going to have for dinner.
Okay, it's going to be one of those as well. Stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities say the suspect in the shooting deaths of 10 people in an Asian community near Los Angeles has killed himself. The attack took place in a ballroom during Lunar New Year celebrations. Now, it's believed the suspect, described it as Asian male, tried to carry out a second attack nearby. In the UK, ambulance workers are walking out today in the biggest strike by first responders. Trade unions are protesting pay levels in Britain's National Health Service. They're demanding a double-digit pay hike. Germany and France warn that European businesses will have to ramp up spending to compete with the U.S. and China. German Chancellor Olaf Scholz and French President Emmanuel Macron met in Paris on Sunday. They discussed how the EU should respond to President Biden's Inflation Reduction Act. That measure includes roughly $500 billion in spending and tax breaks to benefit U.S. companies. Bloomberg's learned that President Biden will name Jeff Zients as his next chief of staff today. Zients is a former business executive who was one of the chief architects of Biden's initial COVID team. He'll replace Ron Klain, who will leave in the coming weeks. The White House chief of staff is among the most powerful figures in Washington. And Spotify is expected to be the next tech company to announce layoffs. Bloomberg's learned that the music streaming giant is planning layoffs as soon as this week. Spotify's stock fell 66% this year as investors question when they'd see returns from big investments in podcasting. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
There's enough softer price and wage data for this Fed to, I think the way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough. I am quite uncomfortable that they've actually done enough here, and I think we're going to see that in some of the upcoming data.
Andrew Hollenhorst, Citigroup, with really an eventful week on Bloomberg Surveillance. We thank them for making available their lead economist. And I really can't say enough about that conversation. I got many, many notes off of the intelligence of the kid from UCLA. Andrew Hollenhorst, Lisa just killed it there last week. They were at 50 beeps. They go to 25. But the heart of the Citigroup matter, along with so many other people in the parlor game, if you will, is they will not retreat from where we're going. It may take longer to get there, and then a level in that and all the stuff you're addicted to. But the bottom line is they did not retreat from 5.x%.
Should I just say bonds, 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 bonds over and over again, just to make sure that you have full faith in my focus?
If you get a Fed world they're talking about, I think it's price down, yield up. But
for which denomination? It sort of depends on whether people think that there's going to be some sort of recession that gets induced by that rate, and then all of a sudden people start investing in the longer term debt. But these are the questions that people have kind of shrugged off because they believe in a soft landing, which I think seems more likely with certain of the aspects, with energy, with what we've seen with a warmer winter. But does that sort of upend this idea of the Fed backing away, which a lot of people would want to see?
John Farrell in London. We'll talk bonds with John Farrell here at the top of the 8 o'clock hour. Lisa Bramowitz, ensconced back from Davos. I'm Tom Keene. Thank you for joining us on radio and television. It's really important to book Damian Sassower in the year of the bunny. We're doing that right now. It's a Chinese, Asia's shut down, right? Year of the bunny?
It's the year of the bunny. Asia's shut down.
It's a year of the bunny.
Michael Jordan, Brad Pitt. We talked about this Sting, George Michael. They're all bunnies. They're all hopping around out there. I mean, I'm not a bunny. I'm a tiger.
How does it shut down? The entire Asia continent shuts down?
It shuts down. I mean, look, I mean, it wouldn't shut down. It's a week. It's Golden Week. It's Spring Festival. People go home. They spend time with their families.
Can they
so
do
you
that
get a lot of
with the
mobility.
COVID, the COVID. How does COVID overlay on that?
Well, we're going to find out. I think it's going to be a very interesting holiday this year, given what's going on with COVID and what's going on with hospitalizations and everything. So,
link in your world a micro decision or choice of a China recovery into a given country. How does it impact Vietnam or Indonesia or, you pick the country?
Well, I heard Lisa talking earlier, she had some good conversations out in Davos about how, it's very difficult to move your business out of China entirely because you want to sell into China. And so if you move out of China, you're not going to be able to sell into that market, right? Which is a very good point. So there are some real decisions that need to be made, but rest assured, we are seeing a lot of people, re-engineer their supply chains into places like Southeast Asia, like Vietnam, as you're referring to. Although it's not at the pace, I think, many like Leland Miller and a lot would have expected. Certainly we're not seeing the reshoring into Latin America, into Mexico and Brazil that one would have hoped for. But those currencies have absolutely killed it. And look, I mean, now is the time as an emerging market practitioner to be looking to receive in emerging markets, right? Because if you do indeed believe that the Fed's going to pause at some point in time, that means the other markets are going to probably pause as well. And you're going to look to, receive in the front end a lot of these curves. A lot of people are starting to look at Brazil, Mexico to that extent. They're looking at Eastern Europe, Hungary, the Czech Republic finally. And so, I think there's probably some legs there.
I have to say, I actually Googled Year of the Rabbit after you said that because that's what I did. And there are fireworks that come up, and it said that people who are born in the Year of the Rabbit are believed to be vigilant, witty, quick-minded, and ingenious. So just some value add there. As we talk about the reopening of China in this new lunar year, there is an issue of its effect on commodity prices, with a lot of people, from Chevron CEO to the head of the IEA, coming out and saying it will probably boost prices of crude. How does that upend or add to some of the emerging markets bet that a lot of people are piling into?
Well, I mean, the bet has been a softer dollar. Here's the interesting thing you have to think about, right? If we do see inflation remain sticky for longer, let's call it 4%, not 2%, right? Tighter conditions are going to be here to stay. And let's just look back at the last 10 years. Well, let's look back since 1970. We've had a number of bull markets, in emerging market currencies and foreign currencies in the dollar. This dollar bull market is 4 years longer than the last two since the 1970, and it's been 11 years in running prior to October of last year. Secondly, if you look at the growth in privates as opposed to publics, I'm talking equities primarily, 11 times growth in privates, only 3 times growth in equities. I mean, it's still a pretty big number, but this just shows the amount of these liquidity conditions, these easy money conditions, how that engineered all the stuff that's out there in private land that's going to finally rear its ugly head, I think, if conditions remain tighter for longer. So I agree with you. Rising energy prices, copper prices are up 11% year to date. Copper's up 5 out of the last 7 years, Lisa. So, if you're talking about the bull run in commodities, if you're talking about coppers and oil, I agree with you. Sticky inflation, it's going to be a risk.
Do the fundamentals matter if you get a prolonged sell-off in the dollar?
No, not anymore. I think the dollar is really the beast that keeps kicking. I'm not going to lie to you. There's so much noise that go into what drives the dollar each and every day, money flows and all that kind of good stuff. But the dollar is really the kicker here. When the dollar moves, everything seems to kind of wake up and follow. You know, we could talk about fundamentals till we're blue in the face, but if the dollar's moving the wrong way, it doesn't matter.
You alluded, I got to get to football here in a moment, your true expertise, but, you know, it's the only reason we had John. Yeah. But very quickly here, what are the emerging shadows in EM? There's just barely percolating this discussion of shadow banking, shadow economy. I thought the Telegraph did a great job on this in Davos as well. What is the EM shadows out there you're paying attention to?
Well, India and Mexico have huge non-bank financial kind of sectors.
Private
shadow financing, right? Which is kind of legal. I mean, they're publicly traded huge companies in many respects.
Who has risk to that? Is that like names we know, or is it?
They're in your portfolios if you own emerging market U.S. dollar debt fund, or some of those bonds probably are in there. And wish you would be able to sell out of them at this point, because it's not really a sustainable model for funding a domestic economy, in my opinion. But you have to resort to those types of, those kinds of shadow funding kind of sectors crop up because you can't bring dollars onshore. You can't get funding external.
I've already gotten messages saying you're so gloomy and doomy, even if things go well, you're still gloomy and doomy. Is that basically what you're saying? No, I mean, honestly, is that basically what you're saying? That people are all positive on emerging markets, but you still see the shadows out there that could potentially rear their ugly heads and lead to some sort of crisis?
I'll get a little bulled up here.
Okay,
so listen,
what's
if you
going
want to talk about the bull opportunities, and I hate to say this because I'm going to get beaten up for it, but I mean, you look at Ukraine and you look at the value and the unprecedented support for that economy. I mean, they've got a lot of dollar bonds out there, a lot of GDP warrants. I mean, some people are going to look for value there. You talk about the elections that we're seeing in Nigeria. Peter Obi, Labour Party, may not get a PDP coming in. He's promising to reprofile their debt. There may be some value there. Argentina, the whipping boy of emerging markets, is just the 29s and 30s. They announced that $1 billion buying back program went from 19 cents to 30 cents in a week. Sorry, you don't care.
We didn't have you on for this. We're talking football now. There was a snowball, very different than Green Bay. It was really a sloppy, gross, ugly, clumsy game. That's fine. But let's move on to what, am I right, a dream match of Eagles 49ers? I mean, this is what the networks and all that, and I'm guessing the betting world is loving.
1.5 point spread there for those who care.
Next to nothing.
Next to nothing. Jalen Hurts looks awesome. The Eagles look awesome. I mean, their defense looks great. But, CMC, I mean, Brock Purdy, I mean, the 49ers are good. But the real story, you hit on it, was that snowball was Joe Burrow. I mean, Joe Cool, man. I mean, he was throwing lasers in a blizzard. I don't think I've ever seen anything like that. I mean, he is awesome.
To be fair, is 49ers Eagles the real Super Bowl this year?
No. Absolutely not. I think, actually, if anything, I'm more impressed by, before Patrick Mahomes got hurt, I mean, the Chiefs and the Bengals look to me to be the favorite. But, I mean, the Eagles look good. And both games are about 1 to 1.5 point spread. So they're both going to be very tight games if Vegas gets their way here.
Is the betting just growing in leaps and bounds? I mean, has it become like a British equivalent to Premier League? Pharaoh's bet, I don't think his mother knows it, but he remortgaged her house today on Fulham and Tottenham.
So I've done a little bit of data on this. There actually is kind of geo-mapping data on this. The Lincoln Field, Philadelphia. You want to talk about a city that gambles? If you could actually see the hotspots of them hitting FanDuel and DraftKings, it's unbelievable.
Unbelievable.
Lincoln Field more than any other field in America by far. So if you saw what was going on the link, I mean, to quote Joe Slay, it was lit, man. I mean, Philadelphia was awesome.
We're always lit when Damian Sassar is with us there on the sport to come on American football and, of course, English football. John Farrell on assignment in London. Lisa?
You keep saying that, and he's saying that he's what, watching the game?
No, he's going. I think he's in. No, he's in the hammy stand. It's this little. It's like Wrigley Field in Chicago. It's this little tiny, completely unbuilt. I don't know.
I bet that
I wave to him when I come into Heathrow.
All I know is that he actually eats his pie correctly, unlike you that tried to do a knife and a fork,
photographic evidence
which
of
evidently
this.
is really a faux pas.
Little meatsy pie thing, somebody comes up to me. I'm sitting there with Mrs. Keene and the rock star. She's, thank you, Tottenham, and they're like, sir, you're eating the pie wrong, and they had to show me how to eat.
You do not do that. It's not like
We're going to come back. I think John Farrow's with us here because we got the pie all over my face.
That was great on radio.
Mrs. Bloomberg, good morning. Stay with us if you dare.
The
standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Earnings season is here.
Wall Street expecting a bit of an ugly season. People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Investors are really realizing now that a serious growth slowdown is probably ahead of us.
If you look at strategists' forecasts, this may be the weakest year I can remember in terms of forecasts.
This year, very simply put, inflation's peaked, yields are likely to peak, and that's what we have witnessed in the last 6 weeks or so.
The market is leading the Fed on the way up and leading the Fed on the way down.
It's a delicate dance the Fed's trying to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Welcome back. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Television. Tom Keene, Jonathan Farrow, Lisa Abramowitz. John is in London checking the weather. It is the quiet period. It is quiet because the Fed officials aren't speaking ahead of next week's meeting. But I have to say that we're actually now able to focus on the real stuff, which is the earnings that are coming through and that perhaps will justify either the bull side or the bear side.
It's an interesting week with a lot of economic data here. And I'm going to go how I started the show this morning, Lisa. We're going to get first look at Q4 GDP in 29 minutes, and I'm sorry, it's recession gloom, and we're popping on a 10-year basis, 20-year basis, normal GDP. I don't get it.
People are basically looking past the near term and saying things are going to turn the corner, and you have this sort of belief that suddenly we're going to have a good first half and a bad second half, right? The initial take on 2023 was reversed within the first week. Now, how much do we get the earnings? They either justify it or they don't. Mike Wilson continuing to say in the first quarter, we're going to see something that really pushes back real earnings and margins compression.
Bank earnings, I think, show the idiosyncrasies of it. I'll get that out. I can't pronounce it. It's like Monday morning. I'm barely awake here, but I'm sorry. Morgan Stanley, plus, your interview with James Gorman, and Goldman Sachs, and well, not plus, and a few others there. Maybe we get that through it all. Most important conversation at Davos. Let's go to it right now. You guys were brilliant with Gorman on the national debate, which is work from home. I thought that was just spectacular.
Well, right now, if you talk to any executive, they're sick of it. And that's basically what they're saying. With the work from home experiment, on the margins didn't work. On aspects it did work, and it's not going to put the genie back in the bottle. You're not going to see that, as James Gorman said. But you aren't going to necessarily get an all work from home kind of situation. Did you see all the job listings for work from home? There aren't that many, but the number of people who are looking for work from home jobs is just extraordinary as people try to reprise that kind of situation.
My theory on this, going back into the pandemic, is if you sustain work from home, you get a compensation shift because people have to travel. I mean, you know, I'm living large and fancy, and I don't know this, but many of our viewers and listeners, you add up a commute. And it's demonstrable if you're not work from home.
What was interesting during last week's discussions, even Jane Fraser, Citigroup was one of the pioneers. They were saying it's actually okay. It's nice to have flexible work situations. She talked about retraining people if they weren't performing and they were working from home. There was a feeling of frustration that I saw pretty universally between all of the executives.
Why don't you go through the data check? I'm going to look at the Bloomberg Financial Conditions Index, which is just telling me we are not restrictive, and Mr. Powell has work to do.
Well, and that's what you're seeing right now. We were initially negative, but now we're positive on the margins across the board heading into the open, just marginally, basically flat. 39.90. Are we going to get to 4,000 before all of a sudden we get some sort of reckoning, or do we just keep on climbing? You see right now with the euro gaining, it's honestly the strongest going back to November, and I do wonder how long we continue to get that versus the dollar. Strongest since April, I should say, as people look to the warmer than expected winter. How much do we also see the expectation of hawkishness from the ECB pushing that euro higher at a time when people were really positioned for weakness?
Well, I'm going to look at Brent crude up 1%. You see it right now on television. For those of you on radio, West Texas Intermediate, 82.44. Brent crude rounded up, $89 a barrel. It's a different world at $90 a barrel. And I also would point out the idea of Bitcoin printing right near 23,000. You got a feeling of that big equity lift we got on Friday. Will it surprise this week? Right now, there's no surprise. Intelligent conversation in London with our Jonathan Farrell, and he has Mr. Steely of J.P. Morgan. John?
TK, we were just reflecting on the fact that you eat a pie at a football game with a knife and fork. And I'm still trying to get my head around all that.
It was embarrassing. People coming up saying, where's Farrell? It was John. I kid you not. It was painful.
I need to hold your hand all the time. TK, I'll be back in a second. Ian Steely of JP Morgan Asset Management alongside us today. Ian, great to have you with us in the building. I wanted to start here because I think this is really important. In the United States, ask about the debt ceiling and people shake their heads and they're like, not this again. Is anyone asking about that? When you go around and see clients in London and the UK, across Europe, are they asking about it?
To be completely honest, no, not really. Maybe there's the odd person is starting to think about it, but I get the sense there's a case of we've been here, we've seen the movie. There will be a bit of toing and froing, but the reality is, at the end of the day, there will be some resolve around it.
Do you think they should care?
Not yet. I think ultimately you need to wait until we get into the stage where actually there is going to be a material impact. That's going to be later over the course of this year. I always look at the bill market to see if there's any spikes in certain maturities. We're not seeing that yet. So the market's not really particularly focusing on it. And I feel that we've had, over the last few years, this isn't the first time we've had these conversations. There's a lot of other things going on in the world before we get to probably worrying about the debt ceiling.
Well, the ultimate test of that is if the debt ceiling hits the fan, do we buy the 10-year Treasury? The answer in years gone by is yes. Do you see that answer changing?
Probably even more so now, just because actually you've got some yield on the 10-year Treasury. We were happy to buy the 10-year Treasury back in 2011 when there wasn't much yield on the 10-year, and this time there is. So I definitely think that will be the case, and the flight to quality will favour those bonds.
You know where there hasn't been any yield, and hasn't been for several decades, is Japan. I know there's a massive focus for a lot of people here in London, for you as well, looking at fixed income. There was a meeting back in December. We had the meeting's minutes, and it suggested that the government official there actually requested a recess, suspended the meeting. What do you think is going on at the BOJ, and do you think the government is happy with it?
I think the reality is, when you look at where inflation is in Japan, it's not what we've seen in the US, it's not what we've seen in Europe, but it's going up. And at the moment, their policy looks at odds with what's happening. The reality, though, is they don't want to cause untoward volatility in the market. I don't want to liken what's happening in Japan to maybe what happened in the UK a few months ago. Sure. But they don't want to see that level of volatility. So I think what we've learned from the Bank of Japan over the last couple of months or so is that I think we're going to get there, but they're going to do it on their own terms. They obviously widened the band when the market wasn't expecting it. The market was hoping for something last week. They didn't, and they're obviously doing these facilities at the moment to try to keep financial stability. We're going to get there. It's inevitable, I think, but they also want to do it on their own terms.
The two words I want to talk about, normal and market, those two words. I caught up with Jeremy Stretch in the last couple of hours of CIBC, and he said Japan's the next one to normalise. And I said, what's normal? I've got no idea what's normal in Japan when they've been doing this now for decades. The other word I want to talk about with you as well is the word market. Is there a market, a sufficient market with private demand, both domestically and internationally, for Japanese debt for when this BOJ backs away? Does it exist? Is there any sign of the one actually being there right now?
That's going to be a challenge, because obviously the Bank of Japan own a huge piece of the market, particularly in the shorter dated 10 years and in, where they've obviously been looking to control yields. So I think that's an open debate. Obviously, we're going to see the market reprice to where it should do, but the reality is there is a huge amount of securities owned by the bank, much more than any other.
Where should it reprice to if we don't know if there's a market there?
So actually, what you can do is, if you track the 10-year JGB yield and put it on top of the 10-year Treasury yield, and you see Treasury yields move higher over the course of last year, the 10-year JGB suddenly hit the upper bound. Before then, there was a pretty good relationship. So if you continue to track that, you're talking somewhere 70 to 75 basis points, given where the 10-year Treasury is. That probably seems as a good starting point. As I said, inflation in Japan isn't what it was in the US and Europe, but it's going up. We've got wage negotiations coming up in April. I think they're going to have to let that go.
So don't fight the Fed used to be the phrase. I know you've been reflecting on that. Should I fight the BOJ?
I think the interesting thing is, as I said, they want to do it on their own terms. So at the moment, they're trying to push some of the shorts out of the market. If you've got a long-term view, I think you can hold that, and actually yields will be higher over the medium term.
What kind of numbers are you thinking about?
On the yields, I think 75 basis points on the 10-year.
Can they go beyond that kind of number, though, in Japan? I'm looking at the things right now that are taking place across fixed income and with central banks. You're talking about the BOJ backing away from yield curve control. The ECB is doing QT. They've got officials running out all over the place saying 50 basis points, 50 basis points. I think the Bank agrees push back a little bit. In that world, is that bullish or bearish for fixed income at a time where I've got pretty much everyone in fixed income saying buy bonds? All these things taking place, Japan, the ECB, QT, all over the place. Is that bearish or bullish fixed income?
It depends what part of the fixed income market you're talking about. Because the US, where people are looking to buy bonds, has seen the bigger repricing. We've got more evidence over the last week or so that we are having a slowdown, retail sales. We're going to have the Fed who want to slow down from their pace. The European Central Bank, the Bank of Japan, they're behind the Fed. We've only just got to neutral in Europe. And as you said, what is neutral in Japan? Maybe we'll find out.
Got no idea.
So they need to do a little bit more. And I actually think Europe is particularly interesting at the moment, because we were in a world where they were hiking rates to deal with inflation. Now inflation's coming, or likely to come off, because of what's happening in energy prices. That should be good for the economy. Growth is we're supposed to be in recession in Europe at the moment, and we're not. So are the ECB going to maybe have to go slower but further as they try to battle this? So I definitely think there's a dynamic between wanting to own US fixed income and then being a little bit more cautious in some of the other markets around the world.
I wanted to squeeze this in because I asked this question earlier. I'm going to ask it all week. Does the ECB hike more than the Fed in 2023?
Yes.
seems to be the takeaway at the moment. Instantly, this was fantastic. It's good to see you from JP Morgan Asset Management. TK, that's two guests in the last couple of hours who have both said the same thing. This ECB in 2023 set to hike more than this Federal Reserve.
You got to see that, John. I looked at it this morning. First chart I looked at was ECB on their financial conditions index, and they are way, way behind the improvements that we've seen both in the United Kingdom and in the United States. John, if you go across the Putney Bridge today, I mean, you're out there at Fulham watching the game, and I've done my research, John, and the next time I'm there with you, I don't know why I'm not with you now. Bramo said, you know, I just don't want to be alone, but the steak and whiskey pie at Putney Pies, and I talked to them. They said they'll even teach me how to eat it correctly.
I'll get you a pucker pie, Tom. I'll send it back. Maybe I'll get you a couple of frozen ones. Chicken and mushroom used to be my thing.
I'd like those.
It's a pucker pie. You
bring a brace of those back
kind of
for.
This will work well.
You know, bring a brace of those back for the team and
Do you microwave
Bramo
them?
And
Do you microwave them?
So I think this is the one day of the year that I think our fans in New York, Tom, are happy that we're talking about international football and not your kind of football.
It was.
After what happened with the Eagles.
It is.
We won't talk about it.
Well, I agree, and frankly, I like the pace. You taught me I like the pace of English football versus the takes forever American football. John Farrell in London all this week with important conversations as well. Lisa Bramlett and Tom Keeney here in New York. Futures, they go green, up 6. Stay with us. Great guests in the next hour with Farrell from London.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities are trying to figure out the motive for a mass shooting in an Asian community near Los Angeles. 10 people were killed when a gunman opened fire in a ballroom during Lunar New Year celebrations. The suspect, described as an Asian male, was found dead of a self-inflicted gunshot wound. Poland will ask Germany permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister said if Berlin were asked about the tanks, it wouldn't stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. The Justice Department has found more documents containing classified information at President Biden's home in Delaware. FBI agents searched the home for more than 12 hours. They are said to have found classified notes from the president's time in the Senate and vice presidency. Spotify is the latest tech company to cut jobs. The streaming giant said today it is cutting its employee base by about 6%. The company has about 9,800 employees. Before today, Spotify's stock had fallen 58% since the end of 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. Season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I currently favor a 25 basis point increase at the FOMC's next meeting at the end of this month. Beyond that, we still have a considerable way to go to our 2% goal, and I expect to continue tightening policy past this meeting.
To be biased, one of my favorite people now in monetary policy is Christopher Waller. He is a research horse from St. Louis. He is one of those people that was weaned on doing, creating, and reading 30-page PDFs, and he has prodigious abilities. There's all different types, Lisa, at the Fed, and he's the research wonk.
And you have the others, and they all are coalescing around a view that the Fed needs to do more, but perhaps not that much more.
Yeah, well, we'll have to see, and of course that dazzles on to the economic data we're going to see, including important data here this morning. Let me get that up right now. Am I right on that? We've got the leading index here at 10 o'clock, and then tomorrow we go into a raft of economic data staggering to the 26th of the month. And to me, that key first look at GDP. Futures up 8, a little bit of lift to the market, just like what we saw on Friday as well. Dow Jones Industrial Average, 33,547, buttressed right up on 4,000 on SPX. On the equity market now, Gina Martin Adams with a brief here. And Gina, I want to go back to my great mentor in London, Meghdon Desai, with a definitive book on Marxist history and on the travails of capitalism, and The Economist. Meghdon Desai, Lord Desai, has always said profitability, it matters. Where in your world do you see profitability? Is it net income or is it up the income statement?
Yeah, I think this is a great question and a really key question for 2023 in particular, because last year, 2022, was really about shrinking margins, particularly relative to expectations. The analyst consensus is anticipating rising margins through the course of 2023. We have started to see, actually, in this earnings season, company cost cutting is what is really driving the earnings beat. For the first time in a long time, companies are actually missing on sales. So for the first time since the first quarter of 2019, we are seeing the S&P 500 miss the sales expectation, but nonetheless beat the earnings expectation because of those cost cuts. So profitability is becoming a very important factor for performance. And I do think that we'll see that continue to perform all year.
I don't want to pin you down on this, and I understand sector to sector, particularly banking is an X, it's nuanced. But if revenues are lighter because of disinflation, let's suggest, and we come down to gross margin and then various and sundry CFA margins, and then we waltz over to free cash flow, which measure of profitability is the one to study?
Yeah, so we track operating margins very closely. And to your point, that's very difficult to do when you're thinking about the financial sector, which you really have to analyze separately. Nonetheless, we do look at operating margins. We analyze the operating margins for 9 of the S&P 500 sectors, excluding financials and real estate, of course. And intriguingly, operating margins are on or beating expectations for most sectors so far this season. Now, what's most interesting in the broader landscape is the reason for the sales miss. And I think that that's really important to understand. Why are companies missing sales and what companies are missing sales? And most of the miss is because of the decline in commodity costs. So we're seeing it concentrated in expectations for energy and utilities companies, as opposed to the broader index, which has serious consequences for what you're thinking about in terms of an inflection point on earnings. We believe that 2023 will be a year where you see earnings inflect more positively into 2024 because of this margin dynamic. But I think we want to watch really carefully over the next several weeks of earnings season. You know, we really kick off earnings this week with about 90 S&P 500 companies reporting. We see the next 3 weeks as the most critical and most consequential for really framing that outlook for an inflection point on margins, an inflection point on earnings in 2023.
So what do you make of all of the narratives, Gina, that you have companies that aren't going to lay people off, not necessarily in the tech world, but elsewhere, because they couldn't get workers during the pandemic and they've been scarred by that. So they're not going to lay off workers to cut costs, and they're just going to see it in their margins. Is that basically a myth, or are you starting to see that?
Well, I think that it is very industry by industry, Lisa. You're correct to point out that a lot of the cost cutting so far and the layoffs have come in the tech space, where we saw some of these tech companies double their workforce over the course of the pandemic. So they're seeing, you know, we're seeing somewhere between 5 and 10% layoffs into 2023. I do think it is industry by industry, sector by sector, though, because there was limited overhiring in some segments where they couldn't find workers. So they're not going to necessarily get the margin benefit. Now, when you look at the true weakness in margins and you focus on the operating margin lines, the areas of weakness were concentrated in the tech space. It's the communications stocks in particular, but also the tech companies, to a lesser degree, consumer staples companies and some consumer discretionary companies where you have some issues with margins. Those are the 4 sectors I think you watch most carefully. The rest of the index is going to be less about margin, significantly more about sustaining revenue growth as we go through the economic cycle. But it is not, we can't paint the whole index with one big broad brush when it comes to this issue. It certainly is much more idiosyncratic risk at the company level, and then even broader at the industry level.
Gina, I was reading Mike Wilson's comments over the weekend, and he's been pretty consistent in his message. And he said, the question is, when will equity indices price the current weakness in the leading data and the eventual weakness in the hard data? They believe it's this quarter. How do you push back against that if you don't necessarily believe that you're going to see that margin compression?
Well, I think we all can sort of argue about how much was already priced, frankly, in 2022. Our models would say that in the downdraft that we saw in June and then again in September and October, we already priced a pretty significant earnings recession coming into 2023. It's a difficult time in the cycle, frankly, because investors are scared of this word economic recession, but the reality is the earnings stream has been in recession for more than a year. We look at overall unadjusted earnings. They peaked back at the end of 2021. They're down about 7%. The analyst consensus is already expecting them to drop double digits over the course of from peak to trough. So there is a degree of weakness that has already been priced and also is already anticipated. I think we're starting to see that with the earnings season, where company beats are being rewarded at double the average pace. Company misses are certainly not being punished with stock price declines. And from that respect, it would suggest we've already priced a strong degree of weakness. I think you do have to have further evidence that things are going to get much, much worse for stocks to react extremely negatively in the first quarter.
I mean, Gina, very quickly here, we're gonna run out of time, but I got another lift in the market. I've got Dow futures up 88, SPX up 9 as well. We saw the big lift on Friday, and all I do is go back to the gloom of 73.74 and whammo 75.76 back-to-back 2 years. What precludes that from happening again?
Well, I think the inflation dynamic certainly reminds us all of the mid-70s or even the early 80s, which was a lot of volatility and inflation, certainly whipped around stock prices. That said, I think you do need to understand where you are in the economic cycle and what has been priced by the equity market. It is extremely important to understand that equities do precede the economy. Equities do price what is likely to happen in the economy over the next 12 months. Over the prior 12 months. So what we're doing in the equity market analysis that we do now is saying, where are we going to be in 2024? Because that's important to consider for framing your outlook and for your positioning. And frankly, our work would suggest we will be in that early cycle recovery by sometime in 2024. That means 2023 is an inflection year for the U.S. equity market, where you start to rotate into early cycle sectors. You start to think about where the value has been unlocked. But you have to do so on a company-specific and industry-specific basis when valuations are as high as they are and inflation risk is still relatively high.
Gina, thank you so much. Gina Martin Adams to get us started strong on Monday on the equity markets. And again, a big lift on Friday. Late. Some people missed that. In red on the screen, and now Lisa reversing futures up 9.
That was my fault, you're saying? Basically, I'm back and
No,
so things are bearish. Like Lisa's reversing futures. I do wonder, though, when is bad news bad news? And we asked about that last week, and this will be a week of discussing that as well.
Bramo's back. We'll analyze when is, well, how about when is good news good news?
Sure,
Yeah,
that's the other flip
you.
side.
We'll do that. Claudia Sam, anticipated. Stay with us.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance Monday morning on radio and television. Thank you for joining us on economics, finance, investment, and international relations. Haven't even touched on Ukraine and the tank debate that went on all weekend, and I would suggest picked up and got some steam to it. John Farrow in London, look for his effort here in 29, 30 minutes as well. He's got a great set of guests lined up. I noticed, I believe, Christian Momani will be on there, who's got real money at risk and has to make real allocations forced into the market. Cash is not a luxury for Dr. Momani, and that'll be interesting. An interesting conversation. Lisa Abramowitz rumored Back from Davos, is there let jag? Do you have let jag, or are you back?
I don't know. You can judge. You can judge me in about a half an hour and tell me whether I'm jet lagged. It's great coming back from Europe with the jet lag actually being somewhat convenient for our schedule.
It is. It works out as well. Lisa here, and we'll get through the week together. Mr. Farrow, again, in London. That's a good thing given all that's going on over there. Lisa mentioned the labor unrest in the United Kingdom as well. Fish is up 6. We had read on the screen earlier, there's a little bit of a pop to the market. The VIX right down on a 20 level. Don't want to make too much about it, but we're watching with yields higher. I'm going to call it a more constructive tone in the market. And let's round it up, $89 a barrel on Brent crude. Maybe that's the thing to watch into February. And I would note a Bloomberg Financial Conditions Index, which is miles from restrictive as well. This is a joy. She's hugely controversial. Always brings up a fire of emails and social and Twitter and the rest. She's Claudia Sahm, who was Michigan economics and really thoughtful about this identification of inflation, the link to the labor market, some of the older theories that maybe don't work, and some new research that needs to be done. She's, of course, with Sahm Consulting and a former Fed Reserve economist. Claudia, let me go. I want to get to a more thoughtful thing, a more theoretical thing, but in your note is something that is ancient. High inflation cures high inflation. That is foundational. Discuss that concept.
Right. Well, we have to remember the Federal Reserve does not set prices. Right. What we see is inflation. They're in there, right? They're raising costs of things like borrowing, which are important in decisions, and yet this is an interplay of hundreds of millions of American consumers and tens of millions of businesses. So I, as someone who followed consumer spending very closely in my 10 years at the Federal Reserve, the retail sales last week were kind of a punch in the gut, right? The American consumer, this is 70% of GDP. And yet, this is mainly goods spending, and businesses need to get the signal, like consumers will get price sensitive. So this is the idea of the high inflation. At some point, the consumers pull back, and then the businesses, they got to price it in and at least tamp down that inflation and maybe even cut some prices.
There are the 2 M's in academics. There's the University of Michigan and all the great inflation work done there over the years, and also a small startup school on the banks of the Charles River in Boston, Massachusetts Institute of Technology. Claudia, I want to talk about Olivier Blanchard's new effort, which I think you're in close link with, which really says we need a more rigorous analysis and less a fad-driven analysis of where we are. And the heart of what Olivier's saying is we think the Fed has too much power and that there are other broader long-term factors moving this great disinflation, like demographics, just as one example. Do we put too much weight on the Fed in terms of their ability to fix things?
I think that's absolutely the case when we think about the real economy. The Federal Reserve has big effects in financial markets. That is absolutely the case. And yet their mandate is in inflation and in full employment. And that's been my big attempt is to draw attention to the fact that one of the reasons that we've had so much inflation is our economy was not resilient, whether it was supply chains or we had underpaid workers. And those are not levers that the Federal Reserve can pull. And we have learned in this crisis, fiscal policy is powerful. Something that's powerful, we should spend a lot of time getting it right in terms of how to use that. The Fed we've learned a lot about the Fed, but it is not our most powerful tool.
Well, I want to just say, Claudia, last week, one of the conversations, not on air, behind closed doors, of executives of companies worldwide were not blaming the supply chain disruptions. They were blaming the last payment that was made out in 2021 to stimulate an economy that already was flush with cash. And they're saying it's going to take time for that to work through. But that was the main driving factor of inflation. Do you disagree?
So it's the beginning of 2023. It's absolutely in the mix, right? And this is the thing about, we learned that policy was very powerful. We also took a big dent in consumer spending when everything shut down. There's still a lot of pent-up demand. I think we forget, this time last year, we were coming out of an Omicron wave that really was affecting if nothing else, keeping workers on the job. And then we were hit by the war in Ukraine. Right, there have been some really important disruptions to the economy, to our daily lives since those stimulus checks went out. And frankly, you can only spend those once, right? So there's actually been a drag on fiscal policy that probably has a lot to do with some of the weakness we saw at the end of this past year.
Well, Washington is pretty much in gridlock, so there's a lot of not a lot of faith that they're going to actually do something on the fiscal side to address further beyond what they did with the Inflation Reduction Act and beyond, based on a lack of fiscal impulse and what's going on the monetary side. Do you believe in the soft landing kind of scenario, or do you think that that is overly optimistic based on the empirical evidence that people point to on the margins of a slowdown?
So I worry some about just using the word soft, right? As we come out of this and inflation comes down, this is going to be a bumpy ride, right? We had 3 months of really encouraging data on inflation. If you really think every month after this is going to be a smooth sailing, I think you're deeply misguided, right? This was something that Vice Chair Lael Brainerd said towards the end of December when she questioned some of these simple models of inflation, like this is going to be a bumpy ride. Now, I think to me, it's not as much about the soft, quote unquote, soft landing. 2023 needs to be a path back to something that looks like pre-COVID normal. And it was very disruptive getting away from normal, but I think that's the goal. And the Fed needs to see that, right? It's not just about hitting 2% inflation at some magical point in time. They really have to believe that it's sustainable.
If we're trying, Claudia, to get back to normal, and I think that was a great theme at Davos and greatly a great theme of the show that we've done here in 2023, part of that is that there'll be change, there'll be technological progress, maybe there'll be government support, particularly in Europe with the war. That's all fine, but it pushes us away from the gloom or caution of secular stagnation. Now, that started with Elvin Hansen years ago. Lawrence Summers has picked it up to great effect as well. You've really pushed against that. There's a solemn optimism that we can get back to normal and move beyond secular stagnation. Discuss that. How do we do that in the coming 12 months?
Well, I think if nothing else, the past 2 years have put a big question mark on the idea that we're just in this low growth state. I mean, for the first time in several decades, we had a job-full recovery, right? So the idea that there's just something fundamentally dragging down the economy, I think we should put that into question. Now, when you mentioned the broader trends before about demographics and technological change, I mean, these could be weighing against that recovery. And yet it's also the case that we were much less destructive to workers and businesses through this recession. And that matters in terms of, do we have long-term scarring or do we have some long-term oomph to this economy?
So what are you looking at data-wise? And we get a slew of it this week, heading into next week's Fed meeting. What are you looking for to know whether we're going one way or the other? In other words, the most telling of the indicators.
So I'm absolutely looking at what services spending, what we see, because again, the retail sales was really weak. That could be a rebalancing from goods back to services. We need to see that. And then once the consumer is rebalancing, business rebalances, workers rebalance, right? We've got to take some pressure off of places that don't normally have a lot of spending. And yet if we see services spending that looks like what retail sales did with, a 1% drop, like that's a big red flag in terms of we're losing the consumer. So that's a big piece of it. Obviously, I'm looking at wages because the Fed is looking at wages. And yet they're slowing down. I think the Fed's goal this year is to be boring. And I think they're on track for it. The world is probably not going to be.
Okay, let's make a pact, Claudia. The Fed can be boring. You can't. Claudia Sahm, thank you so much. With Sahm Consulting here, and always controversial, pushing against some of the main tenets of economics. She really lays out the arguments that are going to be had. And again, as I got to bring it up here. I'm sorry, folks, I don't have them memorized. We're all fixated on February 1. I want to get out to June 14th, July 26th. Does anyone have a clue what those Fed meetings will look like? The answer is no.
But people are trying to figure out whether the Fed gets to 5%, whether it's in 25 basis point increments or not, and then holds, right? And just remains there for a longer period of time, which means throughout July, throughout September. December, going through there and not necessarily cutting like the market is pricing in. What I find interesting is some of the empirical data. If you take a look at job searches, they're taking longer. There's a Wall Street Journal story about that. There was a story about how a growing number of companies were responding to a survey are planning job cuts outside of the tech sector. So there is this pressure that just isn't yet showing up in the numbers, and how big that pressure is just remains to be seen.
And what's so important here, and it really doesn't depend on what you're looking at, but in terms of caution, not gloom, but caution into some form of economic malaise or economic soft landing or economic slowdown, contraction, recession, is it happens quickly. There's a huge respect across all opinions, Dr. Sam, Dr. Summers, and the rest, that, to your point, when it goes into the Fed, 3.5%. Do they get out to 4.5% inflation, or does it unravel from there?
The snowballing effect, because if somebody gets laid off, they can't spend as much, and all of a sudden you get all of the negative impacts that are feeding on each other, which could lead to some sort of bottom, some sort of catharsis. I'm wondering, since people are saying it's going to get pushed out, does that mean it will be short and shallow? I mean, that whole discussion that seems to be consensus, or will it be something different than that?
We'll have to see. The agreement we have is markets go down, Bramo does a data check, markets go up, I do the data check, so I'll pick it up here. Futures up 7, Dow futures up 82, the VIX 20.06. I think that, I'm sorry, it's important. Bitcoin on the edge of 23,000 for those keeping score. Brent crude rounded up, $89 a barrel, up a stick. That has my attention. Dollar stronger after a weaker dollar morning. Please stay with us. Jonathan Farrow in London coming up at the 9 o'clock hour. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities say the suspect in the shooting deaths of 10 people in an Asian community near Los Angeles has killed himself. The attack took place in a ballroom during Lunar New Year celebrations. It's believed the suspect, described as an Asian male, tried to carry out a second attack nearby. In the UK, ambulance workers are walking out today in the biggest strike by first responders. Trade unions are protesting pay levels in Britain's National Health Service. They're demanding a double-digit pay hike. In France, President Emmanuel Macron's government is moving ahead with its pension reform plan despite threats of more protests. The proposal would raise the minimum retirement age from 62 to 64. More than 1 million people took to the streets last Thursday to protest the plan. More are set for next week. Bloomberg's learned that President Biden will name Jeff Zients as his next chief of staff today. Zients is a former business executive who was one of the chief architects in Biden's initial COVID team. He'll replace Ron Klain, who will leave in the coming weeks. The White House chief of staff is among the most powerful figures in Washington. And hedge fund Elliott Investment Management has taken a multi-billion-dollar activist stake in Salesforce. The firm says it's looking forward to working constructively with the business software company. Shares of Salesforce have plunged since their peak in 2021. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
We're not seeing huge demand into high yield so far this year. What we're seeing, I think, is more technically driven. There's no supply. We are still anticipating a widening of high yield spreads when that recession comes, and timing that recession is difficult, but when we do see that recession, spreads tend to widen to at least 800 basis points.
Kelsey Barrow of JP Morgan Inspired. We've done a lot with JP Morgan recently, and I must say they've got a diverse set of opinions all centered around attempting to game a recession. John Farrell getting ready in London for the 9 a.m. New York time hour. Lisa Abramowitz and Tom Keene here in New York. Lisa, I go back to NBER, what Mr. Podesta's doing there, and the idea of 2 quarters of decline. You know it's a recession way after it is a recession. But can we say we're in a recession right now? I hear a lot of people walking away from that.
Because there have been a number of surprises that have been to the upside, right? China reopening, people's viewing this more as the positive than the potential inflationary impulse. And then you have warmer than expected weather, which has really helped Europe. So a lot of people think we're okay. Does the GDP print change anything, even if it's technical, that we get out on Thursday, excuse me?
You know, we're going to have to see. And to me, and this goes to the economic data, which is first seen in the bond market. Let's cut to your expertise. What have high yield spreads done after your sojourn in Europe? The answer is they can continue constructive, right?
They were constructive, a little bit of a sell-off when you had a little bit of the wobble in equities, and then constructive once again. People seeing the opportunity for yield more than the opportunity for default. And that, to me, highlights how people are looking through this and seeing corporate strength regardless of higher financing costs and potentially weakening consumers.
Very good. What we're going to do right now is speak to someone who invented it. I really can't say this enough. I'm going to go back to the shock and awe of point and figure charts of 1880 and through the early part of last century. And then in the 1940s, there was dropped upon us someone who said, you can plot a stock and you can draw lines of support and resistance. His name was John Magee. One of his great disciples was Ralph Encampora. To say he's a chartered market technician, co-founder, barely describes his contribution to looking back at what price tells us about forward. Ralph, honored to have you with us today. I want you to discuss the modern idiocy over catharsis. We need catharsis to make a bottom in the equity market. Have you observed catharsis that drags us out of this bear market?
Absolutely, Tom. Thank you for that kind introduction. I have to stress October 13th, Tom. The Dow had an intraday price swing of 1,502 points. No one's talking about it. In technical parlance, that's called a key reversal day, when the low of the day and the high of the day precede the previous day's high-low. And that, to me, was a major turning point. And since that October low to the December 13th high, the Dow is up about 21%. The S&P is up about 18%. So there's been a nice recovery. And since then, the market's been consolidating. I think we're making a bottom long-term in this bull market.
Ralph, the study of technical analysis, with great respect for Dow theory and the rest of it, was done at a time of non-derivative instruments. We now live in a world of ETFs, of massive indexation and all. Do the formulas of support and resistance that you helped invent, do they work in this time where the New York Stock Exchange really isn't the New York Stock Exchange we knew?
Yes. I appreciate that question, Tom. But remember what technical analysis is all about. It is following the laws of supply and demand, buyers versus sellers, and that has never changed. The emotion of investors has never changed. Fear and greed is all manifest in what we follow. So if you believe in price, which I do, I don't own an indicator, I own price, and I follow the trend of price. Buyers push them up, sellers push them down. It's that simple.
Ralph, on the spectrum of risk versus fear, of risk appetite versus taking all your chips off the table, where are we?
For me, I've taken I've 13th low, and I think since then, if you look at foreign markets like Europe and you look at emerging markets, they have been leading the U.S. market. So I think it's broadening out. So I'd say put chips on the table, play the game.
What makes you feel like this has staying power, like this is the early stages of something more sustained versus a head fake ahead of something that a lot of people say is a necessary byproduct of monetary policy?
Good question. Remember I was talking about October 13th? Low. And it rallied in 2 months to December 13th high. And that since December 13th, we've had a pullback. The Dow has dropped about 6% or so. I think the S&P had an 8% decline. And those levels right there, we are looking at, that would be 32,581 on the Dow and 3,764 on the S&P. Those are very short-term support levels. That's where the buying should be in. I keep my eye closely on that on a short-term basis. And I think we're holding up well.
Ralph, I want to get back to the arch issue of the day, which is the failure of the American retirement system, because people are in and out of the market. We're at one of those moments right now where millions of people are literally saying, how do I summon the courage to get back into the market? And I'm going to go to the crew that you and I are weaned on in Larchmont, New York, Mike Burke, Chartcraft, Mr. Cohen's work, and of course, Earl Blumenthal. They knew when to have the courage to get into the market. How do you get into the market like you did in 1975?
When you say get into the market, you mean participating in trading?
I'm in cash and I need to go long. How do I get back into the market if I'm scared stiff?
Well, again, again, being a technician, I think you got to look at levels. And I think in the days ahead, literally, excuse me, in the very short term, the next couple of weeks, just watch, because we're in the early seasons right now, and we still got a lot of dialogue about whether it's a recession or not a recession. And you got the war in Ukraine. If we can hold above that October low, which I think we will, that to me would be the final test. So in the next couple of weeks, volatility, we hold above those lows.
Right.
I think looking out towards the second half of this year, I think we're going to be in pretty good shape.
Ralph, never enough time. Ralph Encampora there on technical analysis. Just honored to have him on with us today. Lisa, I can't say enough about the legacy of this and the idea of what technical analysis does for you. It's one of the first heated conversations I had at Bloomberg, and with great honor to the late Gary Turkle. Bloomberg has terrific technical analysis as a general statement. What this is about is trend. You're not in the market. How do you get on the trend? How do you stay on the trend? And when do you have the courage to get off the trend? And of all the people we talk to, the one that alludes back to Ralph Encampora is someone like Chris Verone at Strategas.
To me, it's interesting to hear how you can judge in some sort of more objective sense that spectrum of where we are versus fear versus greed. And that's been a huge issue of contention at a time when a lot of people are looking for the silver linings and finding them in real developments versus people who say it is very hard to see how this monetary policy can end up with something that is an optimal
In my experience on this within the daily surveillance babble that we do, John doesn't do babble in London. We'll see that coming up. But Lisa and I do babble here in New York. It's wildly asymmetric in that Ralph Ankampour's world, maybe it doesn't help me get into the market. That's a different set of decisions like what Bramo's saying on TV today. But boy, does it help when you want to get out of the market. That's really where technical analysis does much better.
The death cross and things like that.
She's pushing my buttons. Joel, do something about this.
You told me that I go blah, blah,
blah. The death cross is, I don't know where Ralph is on this. It's absolutely useless. Don't get me going.
It's a very hard moment. Okay, well, right now, to look at the fundamentals, it's hard to get a handle on the fundamentals, which is a reason why technical analysis perhaps is interesting to look at as well for a feeling of the supply and demand that Ralph was talking about.
I'm in the world with Edward Hyman and the wonderful John Murphy. You got to use them all. Technical, fundamental, and a little bit of economics overlaid on top.
And just say bond,
Some people
bond over the top of that.
Next, Pharaoh in London.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Live from the City of London this afternoon. Good afternoon. Equity futures just about positive on the S&P 500. The countdown to the open starts right now.
everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, another day, another tech firm preparing to cut jobs. As the Fed goes quiet, the doves get the last word. And Morgan Stanley says stocks aren't pricing weak data. We begin with the big issue, soft versus hard.
We have seen very mixed signals.
All of the weakness that we've seen within economic data has really been within soft data.
Yes, there's been some weakness in the soft data in the U.S.
Survey data, sentiment data.
But overall, the hard data is looking good.
It really is a question of if we start to see hard data start to roll over.
In the U.S. in particular.
And I think that's the big question for the Fed.
It's going to be the PCE numbers, the core PCE.
We know inflation dynamics have more.
I think PCE is going to be key.
That's one of the key data points for the Fed and I think for the market.
I'm also watching those PMIs.
Every piece of data comes in, it's gonna tell us part of the story.
Joining us now to discuss that story is PGIM's Robert Tipp and Krishna Mamani of Lafayette College. Krishna, first to you. How much weight should I put on the soft data versus the hard right now? And the hard is saying things are okay-ish, and the soft data, the survey data, is saying things are bad.
Well, I think what matters right now is really the hard data far more than the soft data. We have been looking at the deterioration in soft data for quite some time, but in reality, either in the labor market or in growth numbers, the softness really hasn't materialized. So I think there's a sentiment this time around maybe a little different because of all the things that the Fed is doing in the pandemic. The hard data is still very, very positive at this point in the tightening cycle.
Robert Tipp, which side of that are you on?
I think the narrative changed with the retail sales numbers. I mean, granted, surveys have been soft, but we've had an evolution. The hard data, the first series hard data was the negative retail sales, and it wasn't all the drop in gas prices. 2 months, big drop in retail sales. That on the heels of the ISM services new orders, granted that's soft data, I think that signaled a change in consumption behavior. Now that on the hard data side for consumption is soft, but it's absolutely true that on the income side, the job market has remained very firm. So I think what could be happening here is really a change in the savings rate. We saw a big boost in savings with all of the stimulus, and then savings have been drawn down, savings rates have come down. I don't think things are necessarily bad. I just think that consumers may be choking up a bit, like me, choking up a bit on the consumption and boosting that savings rate back up.
Mike Wilson of Morgan Stanley weighed in on some of this. This is what he had to say on it all. He said, while consensus shifts to a less negative stance amid a weaker dollar, China's reopening and the more stable but lagging hard data, we focus on the leading macro and earnings indicators, which are now overwhelmingly weak, a dynamic the market is not priced for. That's Mike Wilson of Morgan Stanley. Krishna, I'd love your view on that, considering you think maybe the opposite on soft versus hard. Where are you on the market and what we're priced for?
So we are certainly not pricing in an imminent recession, which is what Mike is talking about. But the reason we are not pricing it is because it's not unfolding just yet. So it would be very hard for the markets to start thinking about a real hard landing. And in the context of where the labor market is and the fact that inflation is turning over. So yeah, we will start pricing it when the actual data materializes. With respect to Robert's point, with respect to retail sales, I think retail sales may be a seasonal fluke from my perspective. If you look at the consumption data in other parts, in services and things like that, there's really not that much of softening at all.
Krishna, do you think then the pain trade is still up in the equity market? Is the pain trade equities higher?
Oh, 100%. I think the markets are still not priced in for a significant likelihood of a soft landing. I think the market levels, if we think that earnings are not going to be deteriorating rapidly, which would be the outcome in a soft landing, I think the pain trade is definitely 4,500 in S&P.
Krishna, where are you on the bond market then with that in mind?
Well, so the bond market is very challenging at the moment, primarily because it has rallied as much. So I think, one can argue about valuations in equities a little bit, but in bonds, unless we have a hard landing, it's very difficult for me to see how the back end of the bond market rallies significantly from here.
353 right now, yields up 5 basis points on a 10-year, on a 30-year, higher by 5 basis points also to 370. Do you agree with that assessment, Rob, when it comes to the bond market? Hard to make the case for them to rally here without a hard landing.
I think that's true in the short term, and I think that over the next 6 to 9 months, while the Fed is wrapping up the tightening cycle, the back end, as a tactical move, could be under some upward pressure here. I think that, it is a very difficult market to evaluate the underlying economy, the valuations, and on that equity front and the risk appetite front, Morgan Stanley that you brought up had a very interesting piece of research highlighting the huge gap between changes in earnings expectations, where earnings are coming in, what typically happens, and the bearish implications. I think the one thing that may be missing from that analysis, which applies very well, that relationship that they're looking at, it hasn't applied as well in the pre-1980 environment. And it just so happens in those periods, the market, the stock market, came off in advance of the bad economic news like it has this time. And also, interestingly, that was a very high rising inflation kind of environment. So I think, things are very confusing. People are, reticent to take a position, but big picture, it looks like for bonds, we're in some kind of a strategic buy zone, and equities are probably not as dangerous as some may be highlighted.
Equities right now pretty boring. This morning, at least, up 0.1% on the S&P, on the Nasdaq, up 0.1% also. Some breaking news moments ago. Let's get to that breaking news. We can do that with Abby. Hey, Abby.
Hey, John. Well, yes, we do have breaking news just moments ago. Microsoft is to boost its investment in ChatGPT maker OpenAI. This isn't entirely a surprise. Some folks last week were talking about the idea that this could happen. This will be the third investment in about 3 years. They also made investments in 2019 and 2021. Right now, they are considering an investment of $10 billion. This, of course, as ChatGPT is a bit of a talk of the town, if you will. It's very impressive in terms of this AI technology. It can write poetry, create content, even help folks solve problems. So again, Microsoft boosting its investment in ChatGPT maker OpenAI. What's so interesting about this, John, of course, it comes on the heels of Microsoft announcing layoffs, but they are boosting their investments here in their AI technology. And interestingly also, OpenAI, a nonprofit, so Microsoft looking for a way to monetize this ChatGPT.
Abby, thank you. The stock up by about 0.6% in early trading. The opening bell about 23 minutes away. We'll talk about tech in about 5 or 10 minutes' time. The US getting another dose of economic data, the final dose of data ahead of February's Fed rate decision. Mike McKee on top of that. Hey, Mike.
Good morning, John. You were talking about soft data and hard data. How about some hard data wrapped in soft data to start the week? It's something we don't talk about a whole lot, but the index of leading economic indicators, kind of interesting to look at, because if you go back in history, you can see that it has turned down before every recession, and look what it's doing right now. We get that number a little bit later this morning. The rest of the week, it's really not till Thursday till we get anything interesting, and that's GDP for the fourth quarter. The first read on that, we'll see how business investment and consumer spending are going. And then on Friday, income and spending for the month of December. We got that disappointing retail sales report for December, but that's basically goods. What happened with services? Did people spend more money? And of course, the Fed's favorite, the PCE inflation indicator. And this is what we're going to want to be watching because Jay Powell and his colleagues have pointed to PCE services minus housing. And if you look at the rent index in the PCE core, it is much higher, has been growing at a much faster pace than PCE core. That's got to come down some before the Fed's going to be satisfied, but they also know that that's a lagging indicator and it's going to take a while. So we'll see how that turns out. And then, of course, next week we get the Fed meeting and Jay Powell can explain it all to us.
A welcome quiet period ahead of that Fed decision a week or so away. Mike McKee, thank you. Robert Tipp and Christian Mamani back with us. Robert Tipp, I want to come to you on this. This phrase that we heard from the Fed and also from the ECB as well, sufficiently restrictive. Are we sufficiently restrictive at the Federal Reserve, and how on earth would you begin to gauge that?
I think we pretty clearly are. I mean, the inflation data has rolled over pretty convincingly at almost all levels, showing that they have that on the right track. And the interest rate sensitive sectors of the economy, namely real estate, I mean, they're really feeling the pain. And so I think unless they 100% are asked to get a recession, they've done enough. And frankly, I'm surprised that they're going to be hiking at the next meeting or two. I think that they should be skipping meetings at this point. to fully evaluate the impact of what they've done. Granted, I think going, overshooting 25, 50 basis points, I don't think will knock us into a recession, but I think you're right at that point. I think they are sufficiently restrictive.
Krishna, do you agree?
Well, I think we are getting there, but the real test, and the fact of the matter is that even the Fed doesn't know. I mean, they've been telling us that. That is, the way they would know that the policy has tightened enough is some downtrend in the labor markets. And so far, we haven't seen any. And I think that's really the core issue for the Fed. And they are not going to conclude that we are fully restrictive until the lagging labor market starts softening, which is kind of unfortunate because it may be too late in terms of over-tightening.
Robert, Tim, we've got to talk about that. Jobless claims 190,000, unemployment at 3.5%. The quits rate, pick out the quits rate just to look at, is higher. It's not lower. People are confident. They're confident about quitting their jobs and picking up another one. Robert, Tim, which one is it? Are we seeing cracks here, or is this labor market still very resilient?
We'll have to see how these layoff announcements come through. But everything points towards a really solid labor market. I mean, the jobless claims, which are high quality, very frequently released every week. The insured jobless rate is at 1.1%. That is an incredibly low level looking across history. That 190,000 claims, incredibly low number of people making new claims for unemployment insurance. So incredibly strong there. I think the one thing, though, is that is the Fed's job to seek maximum employment. And so while if they are clearly seeing signs of a wage price spiral, they aren't. What they're seeing now is people are asking for wages to get made whole for the kind of inflation that they saw, and they have not been made whole. So you have to expect people are going to ask for that. Last week, we saw a record low union membership, right? So labor is not picking up massive power here in terms of wages. Their job is full employment. That inflation has really rolled over. I mean, the ex-food, energy, shelter has been negative for 3 months in a row. So I think I think they're right there, and I think they're going to get that soft landing.
We'll keep talking about it, particularly the labour market. We'll have that conversation in a moment. Robert Tibb, Christian Mamani sticking with us. In the labour market, in the tech sector at least, things have been brutal. I was going through the numbers earlier this morning. Microsoft, 5% of the workforce set to go. Alphabet, 6% of the workforce. Salesforce, 10% of the workforce. Meta, 13% of the workforce. Coming up, big tech continuing to make cuts.
Right now, it's an excuse for these companies to cut after spending like 19 years rock stars.
It's Spotify up next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
we still see another 5 to 10%. If we get into the middle of the year and there's more and more cuts, that's where it gets darker. But right now, it's an excuse for these companies to cut after spending like 1980s rock stars.
Only Dan Ives of Wedbush could say something like that. Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees. The CEO had this to say: an effort to drive more efficiency, control costs, and speed up decision-making. The move follows Meta slashing 13% of the workforce, 10% at Salesforce, 6% at Alphabet, 5% at Microsoft, totaling more than 44,000 jobs cuts among the 5 companies. And Katie Lyons, you wonder how much work Amazon's got to do, even with its recent announcement.
Yeah, that's a really good point, because remember, just over the last 3 years or so, since 2019, Amazon has added more than 740,000 people to its workforce. This is really what it's all about for these companies, John. They added headcount dramatically. For Spotify, they have more than double the amount of employees today they did in 2019. Their total workforce right now about 2,800 people. So with that 6% cut, that equates to roughly 600 jobs. And then you look at the other companies you mentioned that have cut 12, 11, 10,000 people. In the case of Alphabet, Meta, and Microsoft, they all also added tens of thousands of people to their workforce really over the course of the pandemic, when it was boom time for these companies. We are no longer in a boom time kind of macro environment. And to put it into perspective, how much things are softening in the tech sector in particular, just take a look at profit projections for the fourth quarter that they're getting ready to report. The information technology sector is expected to see profits drop by 9%. That would be the most going all the way back to 2016. But of course, it's not just tech as an industry that is suffering. This really has the potential to widen out beyond that sector. A new NABE survey of business economists just released today said nearly 20% of respondents expect employment at their company to fall in the coming months. That's actually the first time since 2020 that more expect falling rather than increased employment in the next 3 months. And about a third of companies say they are not facing any labor shortages. So this is definitely something we will have to continue to keep our eyes on, as Spotify just the latest in a string of these announcements, John.
Katie Lyons, it goes on, it goes on, it goes on. Another day, another set of job cuts. The one statistic that jumps out to me, and I think we gloss over it way too much. 2019, Amazon, 800,000 employees. 2 years later, 1.6 million. 800,000 to 1.6 million in something like 2 or 3 years. That is absolutely ridiculous how quickly that has happened. Robert Tip, Krishna Mamani back with us. Krishna, this is where the excess has been. This is where you'd expect there to be cuts. I think we're trying to work out whether the cuts we've seen so far are sufficient or whether we're going to see a whole lot more.
Well, so, we can talk about the tech sector, but in the overall GDP economic context, it doesn't really matter that much. It matters for the sector, but for the overall economy, that's not where the problem is. The problem is in the bottom bottom quintile of the labor force. That's where we are missing the workers. That's where 2.5 million people have just disappeared. And that's the sector, or that's the part of the economy that the Fed is focused on. And if you look at continuing claims, which I think indicates that more than anything else, there is really no softening in that part of the market. And that's a problem for the Fed. I'm very hopeful they will solve it, but it doesn't look like it's working right now.
Robert Tip, you think there will be a soft landing? Can I ask 2 things of you? Can I ask first of all how you define that soft landing, and then I'll follow up with something else. What do you mean by soft landing? What does that entail?
Sure. I'm glad you asked that. I'm going to crack a little bit on that soft landing. I mean, we've seen booming growth, and the majority of forecasters in the meantime looking for a recession. And I've been skeptical about that because the things that usually drive a recession or exacerbate a slowdown, like a huge bubble in asset markets, overinvestment in certain sectors of the economy, very aggressive lending, all of those things that once you have a slowdown drag you into a recession, they're not really there. So I think to say a soft landing would mean that you go down towards, 0 to 1% growth for a quarter or two, then you reaccelerate. There's no recession. And I think that the economy right now feels better than it is. The growth rates are low, but people feel jobs, and the job market is strong. So that would be a soft landing. I think with those retail sales numbers and that ISM services dropping, well below 50, that opens up another linguistical possibility for people like Mamani, myself, Krishna, and myself, who've done this for decades. would be the touch and go. You know, that maybe you're going to have like a quarter of negative GDP growth, but then the thing reaccelerates. And I mean at a real operational level. We saw some technical negatives in 2022. But that's how I would define a soft landing, into that 0 to 1 briefly, and then reaccelerating.
Well, the follow-up question then, Robert, is where is inflation in that world, where growth drops down to 0 to 1 and you've seen the labour market still resilient? Where's inflation?
Yeah, well, I think the thing that people forget is that inflation requires real proximate causes. And in the 70s, you know, people want to blame it on Arthur Burns and the Fed, but there were oil price shocks, and that went all the way through the economy, and then we had a surfeit of oil in the 80s, and the inflation went away. You know, the economies run themselves a lot more than the central bankers run the economy. And so we've had a war, we had COVID, we had supply chain disruptions. Those things are passing. The supply is coming back, and we're seeing the inflation. The leading indicators for inflation have been pointing south for some time, and now we're seeing it come through in the data. So I think, you know, we're going to be somewhere on the PCE around that 2%, looking, you know, 6 to 18 months out in the future, as it is dragged down by commodity prices, but also your underlying areas as well, all the way through the housing market.
Can I just pick up on that line, and Krishna, can I ask you if you agree, whether all of those things can take place if the Fed just gets out of the way?
Well, that's a hypothetical that's not going to happen, which is the Fed is not getting out of the way, fortunately or unfortunately. They're doing what they need to do. That's their job. The key issue is, I think from the Fed's perspective, everything is slowing down, everything is falling in place. The real question for them is how patient do they want to be when they get too close to 5%? Do they want to stay there for a very long period of time for PCE to come down to 2%? If that's the case, we will probably have a hard landing, because that'll take a long time and the economy cannot sustain it. I think at some point they may kind of brush it, the 3% number, they may brush it under the rug a little bit and accept it and move on, because they don't want to total the economy either.
That's what people worry about, or some people are excited at the prospect of it happening, depending on how you think about these things. Krishna Mamani, Robert Tipp, to the two of you, thank you, as always. Equity futures right now on the S&P up around about 0.1% on the S&P 500, 6 or 7 minutes away from the opening bell. Coming up, the morning calls, and later, Mandy Zhu of Credit Suisse will be joining us, expecting a year of elevated volatility. That conversation just ahead, the opening bell just around the corner.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Equity futures just about positive here on the S&P 500, up about 0.2%. On the Nasdaq, up 0.2% also. In the bond market, we look a little something like this on 2s, 10s and 30s. Your 2-year yield on a 2-year Treasury high by 4 basis points. The 10-year up by about 5 basis points. Let's get you some morning calls. First up, JP Morgan upgrading Wayfair to overweight from underweight, citing a positive shift in market share trends and its newfound commitment to controlling expenses. That stock up big time in the pre-market. Your second call, Barclays upgrading AMD to overweight, $85 price target, recommending semiconductor companies offering exposure to data centers, PCs and handset markets. That stock's up by about 2.5%. And your third and final call comes from Deutsche Bank, downgrading Workday to hold, expecting another volatile year for software stocks amid weakening fundamentals. That stock is negative here by about 1.1%. Coming up, Microsoft earnings. On deck as Spotify announces the latest round of big tech layoffs. That conversation up next with Mandy Zhu of Credit Suisse. With equity futures on the S&P 500 just about positive by 0.2%. Your opening bout is up next.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Coming off the back of the first weekly loss of 2023, equity futures trying to bounce back, up by 0.2% on the S&P after ending Friday with a decent day of gains, that's for sure. On the Nasdaq, up 0.2% on the Russell, up a little more than 0.1%. The opening bell in New York City ring, switch on the board and get to the bond market. Yields look a little something like this on a 10-year. Your 10-year yield in the Treasury market up 5 basis points, 3.53. Euro dollar had a little look at 109 earlier on in the session off the back of more ECB hawkish talk. Euro dollar comes back down to earth, 108.53, just about negative on the session now. And crude, 82 and about 10 cents. We're positive there by about 0.5%. The opening bell then about 20 seconds in. This Monday, equities advancing by a little more than 0.1% on the S&P 500, on the Nasdaq up by 0.2%. One stock to watch at the open, Salesforce. Activist investor Elliott Management taking a multi-billion-dollar stake. The hedge fund writing in a statement the following: "We look forward to working constructively with Salesforce to realize the value befitting a company of its stature." Ed Ludlow has more on the West Coast. Hey, Ed.
Yeah, good morning, Jonathan. They were up around 3% on Salesforce at the open. Not the same kind of fizzle and exuberance that we saw in pre-market trading, but as you said, a Bloomberg source talks about this being a multi-billion-dollar stake. In the statement you just read out, Elliott did not confirm the investment details or give us a number, but the idea here is that Salesforce grew phenomenally throughout the pandemic period, right? We're at a point where when it reached its November 2021 high, it had a market cap of $300 billion. A lot of that growth was organic, but also inorganic. M&A has been a big feature of Mark Benioff's focus over the last few years, and like many tech companies that you see now unwinding, Salesforce became quite bloated. The reaction from the sell side is this is not a surprise, right? Starboard was the first activist to come in October for Salesforce. They're not surprised that Elliott's coming in now. There's a consensus that the outcome could be good, right? That if you take at face value what Elliott is saying it wants to achieve, actually a focus on profits and shareholder returns could align with what Mark Benioff wants as well, and kind of unwinding some of that pandemic era exuberance. This terminal chart's really interesting. It's not just that drop in market cap November 2021 to present day where it's basically halved, but if you look at forward 12-month price to earnings, this is a cheap stock, right? Historically, at least, forward 12-month PE near its record lows that were set during the global financial crisis. So what I'm seeing in the notes I've read this morning is opportunity, and the stock obviously reacting positively, John.
Ed, thank you. The stock up this morning by 2 or 3%. More broadly, about 2 minutes into this, equities now dead flat on the S&P 500. On the Nasdaq, we're positive by not even 0.1%. Another stock to watch, Baker Hughes, reporting results and turning to cost-cutting measures. This is what they had to say in a statement: "We remain focused on optimizing our corporate structure and drive improvements in our margins and returns profile." Abby has more. Hey, Abby.
Hey, John. Well, yes, and investors at this point seem to like the strategy. The shares are up more than 1%. Now, on the surface, a little bit of a messy quarter. They missed both sales and profit estimates. But what they did do is they beat new orders. They're expanding there to, $8 billion. That represents 20% year-over-year growth. So some real strength there. As for revenues, there was also growth there, 7% year-over-year, but they missed by about 3%. Earnings of 38 cents, 2 cents shy, but that's more than 50% year-over-year growth. So net, the numbers are going in the right direction here. Margins are moving in the right direction, too. Net income of 3.3% last year to high single digits in the years ahead, John. So again, the company's cost-cutting profile idea that is seeming to help the company move in the right direction. And they're targeting $150 million of cost cuts by the end of 2023, or 60 to 80% of free cash flow return to shareholders. Overall, John, we've had a couple earnings coming in place, of course, for the financials, some of the techs, but Baker Hughes kicking off what could be a very strong fourth quarter for energy, 58% year-over-year EPS growth, not so shabby at all, John.
The stock up just a little bit by 5 or 0.6%. I think we hear from Chevron later on in the week. We need to talk about Spotify as well, joining the growing list of tech firms cutting its workforce. The CEO had this to say, and it's going to sound a whole lot like something you've heard before over the last month or so. "I was too ambitious in investing ahead of our revenue growth, and for this reason, we're reducing our employee base by about 6% across the company. I take full accountability for the moves that got us here today." Katie Lyons, we've heard that from pretty much every CEO, I think, over the last few months in this sector.
Yeah, we have. The deja vu is getting severe, John, because it is the same. I take full responsibility. We hired too much too quickly, and now times have changed. To put it in perspective, for Spotify, back in 2019, they had about 4,400 employees. As of the end of last year, they had 9,800. So their workforce has more than doubled. The 6% cut announced today will equate to about 600 jobs that are going to unwind here, and the company's going to take a charge of between 35 and 45 million euros in severance-related charges. We'll see where these layoffs, though, are targeted within the company, John, because remember, Spotify had already laid off dozens of people from its podcast studios in October, and this comes back to the investment that the CEO was talking about. The company made a big commitment to that podcast business beginning in 2019, spending over $1 billion on acquiring podcast networks and the rights to popular shows, and that spending for content has weighed on the bottom line. Spotify has really struggled with profitability, and in this market, profitability is increasingly important. Our analysts here at Bloomberg Intelligence, though, say that these headcount reductions announced today will boost margins as Spotify deals with slower subscriber growth. But can it provide a substantial boost to the stock, John? It is this morning. The stock is up about 6% in the first few minutes of trading here, but remember, it fell 66% in 2022. So far, 2023 shaping up to be a better story. It was up 24% year to date as of Friday's close, and obviously adding to the gains this morning. It is another pattern, in addition to CEOs taking responsibility, that the market reacts really kindly to these kind of job cuts announcements, John.
I've seen this movie about 10 times year to date, 3 weeks into the year. Katie, thank you. Tough time for that sector. Mandy Zhu, Credit Suisse, expecting a tough year ahead for stocks. She writes the following: the outlook for equities remains fraught, with economic growth set to decelerate sharply. With diminishing market liquidity, realized volatility is likely to stay elevated. Mandy, I'm pleased to say, joined us right now. Mandy, great to catch up with you. I was going through your notes, and this number jumped out. You've got the VIX averaging 25 for the year ahead. Can you walk me through that?
Yeah, sure. So, I mean, obviously markets started off very strongly for the year, but one of the reasons we do expect the VIX to remain relatively elevated, at least for the rest of the year, not only because of the macroeconomic backdrop, which I think everyone is familiar with, but also on the back of diminishing market liquidity. And I think that's a point worth emphasizing, is that liquidity in the underlying equity market, particularly equities futures, is actually worse now than in 2020, right? So if you look at top of book depth for the E-minis, which is supposed to be the most liquid instrument for the equity market, it was on average about 26% lower last year compared to 2020, when VIX was obviously much higher. And that was one of the reasons when we talk about equity vol, not doing much last year, everyone focuses on the VIX, right? Implied volatility didn't do much last year, but realized volatility actually doubled last year compared to the year before. So we expect low liquidity as well as challenging macro fundamentals to provide a continued boost to realized volatility, and that is likely to put a floor for implied volatility for the year.
So Mandy, there's 3 points there: low liquidity, real macro vulnerability on top of higher volatility. Put that all together, do we have to adjust our return assumptions a whole lot lower this year?
So, it's interesting because obviously, the market started off strong this year, and it started off strongly on the back of falling inflation and inflation expectations, which is good. But, I do think it's going to take time for markets to figure out whether inflation expectations and inflation is falling because we're going to a soft landing or we're going into a recession. And for equity markets, those two mean very different things. So I think there's a misconception, at least, that a Fed pivot is generally good for equities. When we take a look at the data historically, it's actually it really comes down to whether or not we go into a recession. So in periods when the Fed starts cutting rates and we ultimately go into recession, equities have actually returned double-digit negative returns in the months following, right? So I think for bonds, falling inflation unambiguously good. For equities, it's gonna take time to see. And not
so
just for
you're suggesting, Mandy, just to jump in, that equity bond correlation that normalizes.
Yes, so that was one of the higher inflation and persistent inflation was the reason why equity bond correlation broke down last year. And we expect at least this year it to start to normalize again, because again, we're going from peak inflation to now focus about growth in environments where markets more focus on downside risks to economic growth. That equity bond correlation goes back to negative.
Mandy, with that in mind, can you tell me how investors have been using the first few weeks of this year? Pretty strong price action. Did you notice they were chasing returns, or were they reloading shorts?
Yeah, sure. So I would say on the equity vol fund, the most consensus view is that this year we're going to very much remain in the same regime as last year, meaning, equity vol underperforming, skew underperforming. So most of the structures that we've seen in equity vol space is actually more looking at selling volatility and selling skew in particular. We really haven't seen convincingly, large upside call buying in the market to chase that upside return. For me, really for markets to potentially start to realize on the downside, we really need investors to re-risk and add leverage. And with realized volatility as elevated as it currently is, I think it's going to take a while.
I wanted to get to one trade of yours and talk about cyclicals with you. A lot of people are trying to price this cyclical recovery off the back of China reopening, doing that through China or doing that through Europe. JP Morgan and Mislav Matejka talk about Europe specifically when they say this. They said the recent cyclical rally is discounting the rebound of PMIs into expansion territory, but this might not be confirmed by a sustained activity improvement. This leaves earnings projections susceptible to further downgrades with cyclicals in particular at risk. You've got a trade, Mandy, that is perhaps related to this somewhat. The Euro Stoxx 50 versus Euro dollar. Can you walk me through what you're expecting?
Yeah, sure. We actually have a couple of trades all along this theme that, the rotation of growth into value last year, this year, I think this year is going to look increasingly vulnerable. And I think a lot of the sectors that are so-called value sectors are also cyclical sectors, and they're going to be vulnerable on the downside, obviously, if we go into recession. And European equities, broadly speaking, fits in that category. Obviously, from a valuation perspective, it did better last year given the focus on higher rates and higher inflation. I think this year, where kind of the genesis of the idea came from is our view that peak inflation is really a U.S. story. We actually expect core inflation to continue to rise in Europe on the back of sticky wages. So here, really, this is a play for more hawkish ECB policy. I know there have been some headlines recently suggesting more dovish turn by the ECB. We don't think that's going to happen. So more hawkish ECB focused on taming core inflation in Europe, putting pressure on Euro stocks, and while providing support for the euro. And in terms of entry levels, I would say, obviously, entry level to add protection for Euro stocks is good, but from the trade perspective, it also takes advantage of the historically elevated correlation between European equities and Euro USD. So, that provides a really good discount with the structure.
Mandy, super smart, super smart, and it has been too long, so let's catch up again soon. Mandy Zhu there of Credit Suisse with Euro dollar breaking through 109 a little bit early this morning and then rolling over. Equity futures were positive going into the opening bout, positive coming out of the cash open. We're about 12 minutes into the session. We're positive now by 0.2% or so on the Nasdaq, up by about 0.5%. Coming up, investors weighing the odds of a US recession.
If you look at market indicators, recessions don't seem to be on the cards, but the way that we see 2023 playing out is that a recession is foretold.
Up next on this program, Mike Gapin of Bank of America pushing back his recession call. That's next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
To reconcile the two narratives is that markets are certainly pricing out a recession, right? If you look at market indicators, recessions don't seem to be on the cards. But the way that we see 2023 playing out is that a recession is foretold because we're not out of the woods with inflation. Central banks, including the Fed, will have to power through and push on in terms of rate hikes.
The recession debate heating up, BlackRock laying out two conflicting narratives. Bank of America's Mike Apen weighing in with his own outlook, writing the following. We see enough momentum in consumer spending to push the start of a mild recession into 2Q from 1Q previously. Mike, I'm pleased to say, joins us right now. So to the second quarter from the first quarter, Mike, great to catch up with you. Let's talk about that subtle shift. What's behind it?
Well, as you said, as you noted, we said that there's just enough momentum in consumer spending. So certainly last week, we had evidence, firm evidence, that the slowdown is broadening outside of housing. It's now squarely in the manufacturing sector. But a willingness to use excess saving, a very strong labor market, and maybe some easing in financial conditions has kept the consumer spending. And so we think this week we'll find out personal consumption grew at a 2.5% annualized rate in the fourth quarter, so still very strong. So all of these factors are a tailwind at the moment for spending, so we think that means the expansion goes on a little bit longer. We only moved it back a quarter, so this is not a major change, but we do have to respond to what we're seeing, and right now there's enough momentum that suggests maybe Q1's too early and something closer to the middle of the year seems more likely.
Mike, you pushed this back. Did you change your Fed call alongside it?
Well, we did in the following sense. It seems clear they want to slow down the pace of hikes again. So that, that seems like the obvious change. So we're now looking for a 25 basis point hike in February instead of 50 that we had before. We've kept the terminal the same. The message seems to be we want to slow down, but we are still considering a terminal rate around 5% or above. So we stayed at 5 to 5.25. I think risks around that are balanced. If the economy deteriorates more quickly and inflation continues to slow, maybe they hike and pause in March. But the labor market has been strong, and it's been hard to slow that down. So you could argue that the Fed may have to even do more than the 5 to 5.25 we're thinking. So it's pretty fluid right now. So we just have them slowing down, but it's still getting to the terminal just above 5%.
Well, Mike, let's talk about that labor market. 3.5% unemployment. Jobless claims in the last week coming in at 190,000. I mentioned it a little bit earlier this morning. We look at the quits rate. The quits rate still elevated. Job openings still suggesting something close to 2 openings for every unemployed American. Mike, when we get to the second quarter, what do you think those data points look like?
Well, I mean, we have the unemployment rate rising a little bit above 5% at its peak. And so you're likely going to have some job losses to get that. So we do have employment growth slowing, kind of continuing the pace at which it's slowing, and then turning negative for a while starting in the second quarter. So think maybe 3 to 6 months of softness in hiring and maybe some negative payroll growth. So we have that happening now in the second quarter. The labor market's slowing in that direction, but as you note, on balance, things are still pretty tight, and therefore it suggests the Fed has some more work to do, and it's just going to take longer to kind of remove those imbalances in the labor market.
Mike, do you think there's a growing risk that it gets pushed further out, perhaps towards the end of the year and maybe not at all this year, given how strong some of those data points are?
That's right. We've always said the main risk to our outlook is that the economy just keeps going, and that it's always pretty difficult to slow down the U.S. economy. And if the Fed's really conscious about trying to soft land this and not overdo it, then I think the risk is in the direction of there's enough saving on balance sheets and there's enough employment growth that just keeps the recovery going. So yes, I think the risk is that we have to push things out as the year progresses. That's true.
So the risk for them, they're trying to balance these two risks of doing too much versus doing too little. A few months ago, overwhelmingly, we were told by them, by Fed officials, including Chairman Powell, they believed that the risk of doing too little outweighed the risk of doing too much. Clearly, they now believe those two risks have come into balance. Mike, the way you look at things, do you think the greater risk now as they slow down towards 25 is that they have to pick things up again in the second half of the year?
I don't think so. I think from here they would just the funds rate would leak higher, 25 basis points at a time. I would be really surprised, for example, if they kept hiking and say the funds rate for some reason was approaching 6%. Would the economy power through that? Probably not. I'd be really surprised if we weren't slowing down with a real policy rate that high. So I think from here they can go in 25 basis point increments and still have plenty of time to kind of let this play out. And if they have to go more, I think they can do that. I think the risk of acceleration would be low. So I would say they just maybe keep going at 25 if that's what the data suggests.
Mike, just a final question from me. Sitting here in London, opening up the Financial Times this morning, the headline on the front page, as you might expect, the Eurozone set to escape recession. We look to China and we talk about the reopening over in China as well. Have you got any thoughts on the kind of growth impulse the United States could import from a better Europe, relatively speaking, and a China that could see 5-6% GDP growth depending on how this reopening goes?
Yeah, I mean, the trade channel in the U.S. is pretty small, so I wouldn't overplay that. I mean, and we've been kind of arguing, actually, the weaker the rest of the world is, the more that helps the U.S. because gas prices come back down. So I think it's about neutral. If Europe is doing better and China surges in the second half of the year, maybe commodity prices move higher and we don't get relief on gasoline prices anymore. But we would get a modest boost from trade. So I think that actually kind of washes out when it comes to the U.S. We're just not as driven by global growth as other economies.
Hey, Mike, this was great. Hopefully we can catch up again next week around the Fed decision. Mike Apin there of Bank of America pushing out his call for a recession in the United States from the first quarter out to the second quarter, with a real risk that gets pushed even further out through the rest of this year. And for the likes of Neil Dutter of Renmac, maybe not this year at all, given how things are materializing at the moment. Equities right now, decent day of gains on the cards, maybe up 0.5% on the S&P, on the Nasdaq, up 1 full percentage point. Abby has more. Hey, Abby.
Hey, John. Yeah, we do have the S&P 500 up about 0.5% at session highs on basically a volume that's equal to what it's been over the last 20 days. Not surprisingly, with the gain, we have three of the big heavyweight tech sectors higher: tech, communication services, and discretionary. On bottom, we have real estate, utilities, materials, and healthcare flipping right around. So utilities in the bottom, one of the defensive sectors. One sector that's really outperforming, helping out technology, John, is the chip sector. The SOX is up 2.7%, helped out by Qualcomm and Advanced Micro. Barclays is very bullish on chips, raising price targets and reiterating overweight ratings, John. This sector up 36% since the October low.
Abby, thank you. Up next, your trading diary.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
About 26 minutes into the session, equities up 0.6%. Let's get you the trading diary. US PMIs coming up on Tuesday, plus big tech earnings kicking into full gear with Microsoft after the close, Tesla, IBM on Wednesday, US fourth quarter GDP and another round of claims coming up on Thursday. Finally, PCE numbers and the UMich Sentiment Survey rounds out the week on Friday from London. That is it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. I'll be with you tomorrow morning. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really